Hey, hello, and welcome to those of you who have just joined us. We were just giving everyone a few moments to get their settings sorted and to join us in the session, but I see our numbers are coming up well now, so great to have lots of you here with us. So I think we'll get started with the session. So, a big welcome to this half day of training on applying the IFRS sustainability disclosure standards. This program is really a very collaborative effort between myself and my colleagues at the UN Sustainable Stock Exchanges Initiative, alongside the IFC and IFRS Foundation. And in particular, today, we're very grateful to our hosts for the training, the Chittagong Stock Exchange, for helping to host today's session. And of course, a big thanks to our ongoing partners and supporters of this program, the IFC, part of the World Bank Group, and also we thank the Swiss government for their support as well for this program. So to kick us off, I'm very pleased today that we've been joined by Mohammed Mahadi Hassan, who is the Chief Regulatory Officer at CSE. So Mohammed's going to say a few words to open the session for us. So many thanks for joining us, and over to you.
Thank you, Fiona. Assalamu alaikum and good afternoon. I would like to thank UNSSC initiative for arranging this session on our request. We are grateful to you, and I also would like to congratulate and thank my colleagues for participating in this session. Why I congratulate you? Because you are getting this unique opportunity to attend the session and try to will get the opportunity to understand what's the global vibe about sustainability issues today. And also thank you for creating scope for joining this session amongst your busy schedule. As I said, all of them are my colleagues, all the participants. Some it's a question of proximity. Some belong to my own organization, and some belong to our brokers and dealers. So we all belong to our CSA family. So I always use this unique opportunity to show off my unique academic background. I graduated in environmental science from University of Chittagong, and then pursued my career in finance. So part of my soul is always attached to it sustainability issues. So there are experts in the panel who will take you through the session. Let me give you a brief about what actually this, where we stand on these sustainability issues. The issues, the term sustainability came to surface in, I think, 18th century, 1800th century, 18th century, sorry. And then through the passage of time in last century, we went through, awareness phase. We are trying to the global bodies, especially UN, were trying to aware people about the impact of our development projects on the backdrop of industrial revolution, what the society, what the environment is going to pay for the development that is happening. Then this awareness phase has come to a different phase in 21st century, where we are talking about standardization, creating framework. And as part of this framework, this IFRS has come up with this disclosure requirement. So for a country like ours, we will be graduating to from LDC to developing country status in near or far future, but it is going to happen. We need more FDIs from because to sustain our graduation, and for that compliance is a must. And the foreign investors who are looking for investment opportunities throughout the world, they are very much looking for compliances, especially whether these compliances are related with social harmony, whether these compliances are related with environmental what should I say steadiness. And considering this, we think this session gives us a huge opportunity to prepare ourselves for the upcoming challenge of 21st century's requirement. as a business body, as an enterprise, so that we can take the challenge and we can bring more investment towards our platform. So thank you once again for participating in the session, and we hope that we can make the maximum out of the session. Thank you very much.
Thank you very much, Mohammed Mahadi. Really appreciate it. And great to hear you're a fellow environmentalist. So thanks for joining us today. Really appreciate it. And great to hear, as you say, that positive perspective that CSE has on the adoption of mandatory standards and how it can really support your market. So fantastic. Thank you. Great. And so as well, we're very pleased to be joined by our colleague Lopo Rahman, who is the ESG officer for the regional office with the IFC, which is part of the World Bank Group, as I mentioned. So Lopo will also say a few words to kick us off. So big thanks for joining us, Lopo, and the floor is yours.
Thank you so much, Fiona. Are you able to hear me? Okay, fantastic. Thanks so much for organizing this event. And we have an advisory program in Bangladesh on ESG, where we work with regulators. So the Central Bank of Bangladesh has been one of our key partners and allies, but also the Financial Reporting Council. So we were able to provide technical assistance to help Bangladesh Bank adopt IFRS S1 and S2, so which is now mandatory for all banks and financial institutions to report and disclose using these standards. So first stage was for the regulators, but by 2027, they would have to publish their sustainability reporting based on these standards. So very happy to see that, you have more than 120 participants who have joined. So clearly there's very strong interest from everyone. And I guess the impact jointly that we will be able to create is when we see good quality reporting coming out. And from an investor's angle, which is IFC's main bread and butter, we look at transparency disclosure as one of the key pillars for corporate governance. And therefore, this will give a strong indicator to not only IFC as an investor, but also other development financial institutions and other institutional investors, provide them more confidence when companies start implementing. Yeah. So thank you. And back to you, Fiona.
Thanks so much, Lopa, and thank you as well as ever for the IFC support to these initiatives. And as you say, working particularly in the market in Bangladesh as well. So the IFC's contact details are at the end of this presentation as well, if you'd like to find out more about the work they're doing in Bangladesh. Fantastic. Well, hopefully that set the scene nicely for us there. So from my side, I'll just cover a few practical points before we get into the content of the session itself. So firstly, just on a housekeeping level, it's great to see so many of you already making use of the chat and Q&A, which is fantastic. So feel free to continue to use the chat throughout the session to share any general comments or to introduce yourself, as everyone is already doing so. If you have any particular questions for us, we'd love to have your questions, but we'd encourage you to put your questions into the Q&A box in particular, which you should also have available to you at the bottom toolbar in Zoom. If you use that for your questions, that just allows us to directly answer you so you can keep track of the answer to the question in sequence and make sure it doesn't get lost in the chat, which can get a little bit busy with messages. So please make sure to use the Q&A box there. In terms of our format today, we've got a live 3.5 hour session. We will take a short break in the middle of that time as well. As I've already mentioned, one of the great things I think about these workshops is that opportunity to ask your questions as we go along. So please make sure to do that. And we'd also really encourage your participation in the session as well. So we're going to be doing a number of interactive exercises as we move through the training. We'll be using the polls in Zoom and another tool called Mentimeter, which we'll introduce to you shortly. So we'd really encourage you to take part in those exercises as an important part of the learning in today's course as well. And then finally, if you join us for our full training session today, you'll be happy to know that you can receive a CPD certified completion certificate. So to get your certificate, you'll need to fill out the survey, which we're going to share with you at the end of the training workshop. So make sure to listen out at the end of the session and we'll explain a bit more about how you can get your certificate. So just to cover who's going to be presenting today. So I'm Fiona from the UNSSE team, and I'm joined today by my colleague Lois Guthrie, our senior specialist as well. And alongside us, we're very pleased to be joined by our colleagues at the IFRS Foundation to really support you with understanding these standards and answering your technical questions. So very pleased today to be joined by Bella Cheng and Rebecca Wilkinson-Blanc, who'll be presenting today, and their colleague Robert is also available, who'll be answering some of your questions in the background as well. So big thanks to the three of them for joining us today. So in terms of what we're hoping to get out of today's session, there's really three key areas we're going to be talking about. So firstly, we'd like to help you to understand the ISSB standards, so the fundamentals on what they are. Then we'll move into focusing on how to understand how to use the ISSB standards, so getting a little bit more into the practicalities of how they are applied within organizations. And then our final learning objective today is to help you to identify the steps that you can take to develop your own organization's disclosure plan to enable you to put into practice the ISSB standards. And to help us meet those three objectives, we've broken things down into a 4-module structure that you'll see in that kind of wheel circular diagram on the slide here. So keep in mind the structure, and this will help you to see during the course where we're at in the training content. So we're going to start firstly in our first module, Prepare, thinking about how we can build on existing knowledge that you might have of sustainability reporting or financial accounting, which will help us to think a bit about the purpose of sustainability reporting and how we've evolved to reach the global baseline of the ISSB standards. And then in our next module, Align, we're thinking a bit more about how to practically start applying and using the standards and what additional disclosures you might need to add to meet the requirements of your sector, geography, or regulations, for example. In Implement, we'll be thinking a bit about practices and systems, so how to go about identifying, evaluating, and integrating sustainability-related risks and opportunities into your organization's practices and your disclosures. And then finally, we'll finish in Communicate. So this is all around the final format of your reporting. So thinking about the location and timing of your disclosures, how to do so with efficiency and in a way that engenders user confidence as well. And then just to show you that in another way, this is how the time will break down across our session today, across our modules. As I've said, we'll take a short break in the middle. We'll spend quite a lot of time in the middle of the training on our second module, where there's quite a lot to cover to actually present the detail of the standards to you and all of their requirements and show you some examples. And then at the end, we'll wrap up as well with some additional resources that you can take away to continue your learning on this topic as well. Just to also highlight, the materials that we're presenting to you today are available to download from the page for today's session. So we'll share that link with you in the chat, but on that page, you'll be able to find this slide presentation, which includes links to all of the resources that we're sharing in the chat with you. It also will include the homework assignment that we'll mention to you, and also the further guidance that we've got available from the SSE on these topics. And we'll also add the recording of today's session to that page after the session. Thanks, Lois, for sharing that link in the chat again, which you can follow to access those materials. And as I've just mentioned there, we do have a homework exercise which you can find on that page at the bottom. The idea of the homework is to help you develop your own disclosure plan for your organization, to put into practice what you're learning in the training program. So it's not mandatory to complete the homework, and you don't have to submit it to us or anything like that. It's really just there to help continue your learning and hopefully help build those conversations internally that can help you to adopt the standards. But would encourage you to take a look at the page that Lois has shared the link to there, and you'll find the homework as well. And yes, just to confirm, the recording of the session will be added to that page as well, as I see that was just asked in the chat. And then another companion resource just to mention alongside this program is the SSE's toolkit of guidance and resources on sustainability related financial disclosures. So there's a number of different pieces of guidance, particular training tools on certain topics in this toolkit. And you can find that at the link that Lois has shared there, and as well as accessing it through the slide handout as well. Okay, great. So just to get us started, we wanted to really go into Menti for our first question for you all, which is to get a sense of why you're joining us in today's training and what you're looking to get out of the session and maybe what you already know about these topics as well. So let me just share the Menti screen now. And Lois will shortly share the link in the chat for you as well to see the Menti. Let me just move this over here. Okay. So hopefully you have that available to you now. So if you want to join the Menti, there's a couple of different options. I'll just put those instructions up on the side for you. So you can either go to Menti at the link that Lois has shared in the chat. That link will take you directly to our first question here. You can also use that QR code and join us on your phone, perhaps, if you want to scan the QR code on the screen now. And finally, if you go to menti.com, you can enter that 8-number code that you can see at the top and on the right-hand side of the screen. But I encourage you to join Menti because we're going to use it a couple of times in the training for some exercises. So it's good to find your way into it now, and we'll use the same link throughout the session. But the first question for you is just to get a sense in your own words of maybe why you've joined us today, something in particular maybe that you're hoping to learn about in the training or your drivers for being here. So I see learning, compliance, a few people mentioned learning, the ISSB topics. Great. So maybe particularly interested in ISSB, maybe you have to sort compliance in your organization. I see governance, sustainable finance, certification, training. Great. Thanks, everyone. Lots of good answers. So good to know what you're here for. And then our second warm-up question for you now is just to get a sense of how comfortable you are currently on some of these tasks that we're going to be hoping to move forward with you today. So firstly, how comfortable would you be currently in explaining to your team what the ISSB is, in using the ISSB standards, and in developing a sustainability reporting strategy? So you can use that rating scale there from left-hand side, maybe brand new to the topic, just getting started, to the right-hand side, maybe you're very familiar and comfortable already on this, to let us know what your understanding is currently. And then we'll come back and check this at the end of the session, and hopefully we'll see a bit of an improvement. But great, it looks like most people are somewhere in the middle of the scale currently, perhaps a little lower to middle on some of the parts around developing a strategy. But great to understand where you're currently at, and I think that gives us a good baseline for today's session as well. Great, let me just reshare the slides with you now. You can keep that Menti tab open somewhere in the background, and we'll come back to that later in the session as well. So encourage you to keep that open for our exercises later. But with that, let's transition now into the first segment of our training content. So I'll kick us off with the first part of this and then introduce my colleagues who'll be joining us to speak as well. Before I do, I have a quick disclaimer to share with you before we go into the content. And this is just to be clear about how we're going to be using company disclosure examples in the training today. We'd like to be clear that these examples are not necessarily shared as good practice or the best way to do this. They're really just given to show some examples, some inspiration, and to help put into practice what we're talking about. But just to be clear, when we share an example, each company will have to approach this a little bit differently according to what suits your own unique circumstances. So please do keep that in mind. With that, let's start now with our first module, Prepare. So in Prepare, we're going to cover a few key points, which I'll hopefully cover when the slide moves. Just give it a second. There we go. There we are. So in this module, Prepare, we're going to be looking at really building that solid foundation of knowledge. And we've got 3 key things we're looking to talk to you about in this module. So firstly, the purpose, so looking at the case and the drivers for sustainability reporting. We'll then move into landscape, so thinking about how the reporting landscape has evolved and how it's becoming simplified. And then we'll finish by looking at the global baseline, so introducing the core concepts and requirements that form that baseline, which is the IFRS S1 and S2 standards. So to get us started with purpose, we're going to be really looking at some of the market drivers we're seeing for disclosure. And to get us started on that, I think it would be good to get a feeling from all of you as to what your drivers are. So let me just launch our first poll question for you. So the question should pop up on your screen now, hopefully, for you to respond to. But if you don't see it pop up, you can also share in the chat what your answer to the poll would be. But the question is, what are your reasons for disclosing sustainability related financial information? So you can select more than one option here if more than one of these ones is relevant for you. If we've maybe missed something that you think is important, feel free to share that in the chat with us as well. But just let us know in your own words in the chat, maybe, or let us know by responding to the answers what you think are the most important reasons for your organization to disclose information, or maybe personally why you're interested in this topic. Great. So we always like to see as many people as possible taking part in the poll. So this is where I'll start to have a look. So we've had about a third of people take part in the poll so far. So if you haven't already voted, please do. It's great to get your input to these and to get a sense of what you're all thinking. So I'll give everyone a few more seconds and then let's have a little bit of a look at the results together. Okay, let's close the poll there. Almost half of you had voted. And I see regulatory requirements is definitely coming out strongly here as the top reason for many of you. But a mixture of people also highlighting investor interest and maybe sharing your own management's objectives as well. So good to see a mix, but yeah, can clearly see that regulatory compliance is a top consideration for many at the moment. Great, thanks everyone. So let's have a little bit of a look at some of these requirements or drivers. So one that a few of you highlighted there, and we know that is increasingly mentioned globally, is investor interest in this topic. And one simple way that we can kind of measure that is by looking at the number of investors that are signatories to the Principles for Responsible Investment. So you'll see here that number has grown significantly in the last 5 years or so. And now more than 128 trillion US dollars in assets under management are covered by signatories of these principles. So it's clear that we're seeing any growth and interest in these topics from investors. And why do we think that is? Well, I think what we'd like to highlight here is that really a key driver behind this is the potential financial effects of sustainability related issues and the growing recognition from investors that for companies, sustainability is highly relevant to long-term value creation and strategic resilience. So the data you're seeing here comes from a recent study of institutional investors, which was conducted by HSBC. And this survey found that the top driver for the investors surveyed to incorporate climate change and environmental issues into their investment strategies was the perceived impact of these factors on long-term performance. So this is no longer being seen as a nice to have or maybe an impact investment consideration, but really core to strategic resilience. And so it's important to remember today that we're going to be talking about disclosing financially material sustainability related information. So later in the workshop, we'll go into more depth about what we mean by materiality. But we wanted to be clear from the start about the sorts of financial effects that investors are looking to have more information on. So we'll start firstly with effects on a company's financial performance, which we often see reflected in the statement of profit or loss, which shows us income or revenue and expenditure. And sustainability related risks and opportunities may have a financial effect by changing the revenue mix or total revenue of a company. For example, if demand for its products and services change, maybe its production capacity is disrupted, as another example. And we can also see substantial changes in expenditures. For example, if operating costs were to increase due to energy prices, or perhaps there would be a need for greater research and development expenditure to capitalize on new sustainability opportunities as well. So just some examples of the types of effects on financial performance we could see. And the second lens here are also effects on a company's financial position. So we often see a company's financial position reflected on their balance sheet. And so, for example, a company might experience changes to certain assets or liabilities due to climate or sustainability issues. We could see changes in portfolio value. We might even see write-offs of certain assets that perhaps are damaged or need to be repriced. And another financial effect that could be considered is changes to financing and the cost of capital. For example, this could include equity evaluations that were impacted by climate risks, but also making use of new financial structures as well, such as green bonds or social bonds. Before we move into the next unit, just a few final points to highlight here before we move on. And these connect to sustainability related risks and opportunities. So, firstly, here we're seeing some data coming from the latest Global Risk Perception Survey from the World Economic Forum. And I think what this really shows us is that risks evolve over time. So, those things on the left-hand side, which are the short-term risks, could be quite different from what is actually most material over a long-term horizon. So, what's important for our disclosures is that if we're preparing for a risk that we might be expecting to see in 5 or 10 years' time, it could be that we actually have to invest in new practices or processes to mitigate negative impacts or maybe increase our chances of an opportunity now, which actually could mean that we see financial effects much sooner than the overall time horizon of the risk or opportunity itself, which is perhaps a slightly unique aspect of sustainability risks and opportunities to keep in mind. And so, another important aspect of sustainability related risks and opportunities is their interconnectivity. And so, this diagram comes from the same WEF Global Risks Report. But as you can see here, there are really many different connections across different risk types. So, when we're thinking about disclosure, we might think about separate topic standards. But as we can see here, of course, many of these sustainability risks and opportunities are inherently interconnected. And so, although we separate out one topic or theme, perhaps from a disclosure perspective, that doesn't remove these connections, and we need to do our best to still consider the whole when we're making strategic decisions. And in fact, within IFRS 1, which really sets out the conceptual foundations for ISSB disclosure, there are requirements concluded here relating to connected information, which we'll come into shortly. But really, it's all around ensuring that investors get a holistic picture of the company's sustainability-related risks and opportunities. Okay, so that's our first unit done, and I'll pass over to Lois now for the landscape section.
Thank you very much, Fiona, and hello to everybody. So Fiona's taken us through why sustainability disclosure standards are important, and in this part we're going to look at how those standards have developed. Before we do, though, we'd like to ask you which standards or frameworks you are currently using to disclose sustainability information. So please answer as many as apply to you. Are you already using IFRS S1 and S2? Do you use the Global Reporting Initiative standards or the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, perhaps regional standards? In Europe, that would be the European Sustainability Reporting Standards, or others. Please tell us about any others in the chat, or none yet. Just give you a moment to tell us what standards you're already using. Let's close the poll and have a look at the results now. So you can see that many of you here, 65% already using IFRS S1 and S2. So that's great to hear, and hopefully you'll already be familiar with what we are going to tell you today, and please send us any questions you have about these standards. Then others are using the Integrated Reporting Framework, the Global Reporting Initiative standards. So quite a spread there, and thank you for telling us. That helps us to design the training with you in mind. Thank you. So let's have a look at the organization that developed the standards that we're talking about today. This is the IFRS Foundation, the International Financial Reporting Standards Foundation, and they developed the standards. The IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. So at the bottom of the screen, you can see that there are two independent standard setting boards. The International Accounting Standards Board, or IASB, develop accounting standards, and they are in place in over 140 jurisdictions around the world. The sister standard setting board, the ISSB, developed IFRS S1 and S2 in 2023, following strong market demand for the development of these standards. The two standard setting boards, being within the same foundation, work very closely together to ensure that the financial and sustainability standards complement each other. Governance of these standard setting boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did the IFRS sustainability standards come to be developed? Well, on this screen, you'll see some logos with which you might be familiar. It might look like a confusing picture, but the message we'd like you to take away today is that this is a picture of harmonization and simplification. So the organizations represented here all participated in the evolution of sustainability reporting. They actually have a lot in common. Some of the organizations have been consolidated into the IFRS Foundation. You can see those at the bottom: CDSB, the Integrated Reporting Framework, and the Sustainability Accounting Standards Board. Then we can see other arrows on this screen. The arrow from the TCFD shows that the TCFD's work has been incorporated into IFRS sustainability. Similarly, the disclosure-specific materials of the Transition Plan Task Force are now the responsibility of the IFRS Foundation. CDP has aligned its climate questionnaire with IFRS S2 on climate, and GRI works very closely with the IFRS Foundation to ensure that they jointly identify and align common standards. So as a result, we see the reporting landscape being significantly simplified and harmonized, and there's ongoing work to develop guidance and other materials that are more consistent with each other. Let's just ask you a Zoom poll here. Differences between reporting standards and frameworks still exist, but why? Is this due to differences in reporting objectives? Is it due to differences in scope? Is it because some definitions are different? Is it because wording is different? Materiality focus is different, or is it something else? What do you think? I'll give you a moment to think about this. Sorry if we have to move through these polls a bit quickly sometimes because of in the interest of time. So I am going to show you the results now. Actually, all of these are true, but I think you have answered the most relevant one, which is any differences that still exist between reporting standards are because mainly of differences in their objectives and their scope. So if we take GRI, for example, many of you will know that their reporting objectives are to serve the information needs of a wide range of stakeholders, whereas the IFRS Foundation serve the information needs of investors. So their objectives in obtaining information are different. And also the scope can be different. So GRI will look at impacts as well as risks and opportunities, whereas the ISSB is focused more on risks and opportunities. So well done for picking out the right or the most relevant answers there. So let's move on to look at some of these differences. I won't go into this in detail because I can see not many of you are using TCFD. We've already said that the TCFD's work has been taken over and forms the basis of the ISSB standards. If and to the extent that there are any differences, and there are differences, they are to do with the use of different wording, but to capture the same information. S2 requires more detailed information than TCFD used to. So this might be information about the use of carbon credits to satisfy greenhouse gas emission reduction targets, for example. And S2 provides some additional requirements and guidance than the TCFD did. And an example here is requirements relating to sector-specific information. So if you want to know more, there is a comparison document linked there. But for now, let's go back to the objective of the ISSB, which is to set standards that provide a common language and a global baseline for sustainability-related financial information. And this is to enable comparable and consistent sustainability disclosure across global capital markets. And the Foundation is working with jurisdictions around the world and other stakeholders to achieve this. However, what would happen if our regulators or stock exchanges or others wanted to ask companies to disclose information in addition to the global baseline set out in the ISSB standards? Well, that's fine. They can do that by adding their own additional building blocks tailored to the needs of local regulators and stock exchanges and others that build on the global baseline disclosures. And those additional disclosures can be required as long as the information is presented in such a way that does not obscure the disclosures required by the ISSB standards. So we have the global baseline that gives us consistent disclosures for capital markets, and we have the ability to add building blocks that would capture information perhaps about impacts or effects on stakeholders, such as covered by the GRI standards. There's been global backing for this approach, the global baseline reflected in the standards. In fact, the International Organization of Securities Commissions endorsed this approach and the standards and asked their members to consider how they could incorporate the ISSB standards into their regulatory frameworks. From the International Auditing and Assurance Standards Board, we have a new assurance standard, ISSA 5000, that supports assurance of sustainability disclosures. As I said before, there's work between the ISSB and jurisdictions around the world to help them consider how they can plan and prepare for voluntary and mandatory adoption of the standards, and there's activity to support voluntary adoption. So we're going to hand over now to our colleague Bella from the IFRS Foundation, who's going to take us through starting to explain the standards.
Thank you so much, Lois. So we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it's important to note that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can be information about a broad set of issues, including climate, nature, or biodiversity, human, social, or others. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And what are sustainability-related risks and opportunities? Those are that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, management discussion and analysis, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we will use this generic phrase throughout. Here, we have just summarized the key points of each term, but you can also refer to S1 for fuller definitions of each of these phrases. Anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the SSB standards. These are governance, strategy, risk management, metrics, and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, and I encourage you to download the standards as part of the homework assignment. And now we're going to discuss IFRS 1 general requirements. So to all the preparers listening, let me start by saying don't be afraid. Yes, there is a lot to understand, but you might be surprised that some of the detail is familiar. And for all the accountants listening, you too will be relieved to see many of the conceptual foundations developed by the ISB and in the SSB standards. So let's start with S1, the full title, General Requirements for Disclosure of Sustainability-Related Financial Information. S1 sets out general requirements for the content and the presentation of material information about sustainability-related risks and opportunities. And for matters, if you are familiar with TCFD, you will see the same architecture applied to all the standards. For matters other than climate, S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information about them. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. And the scope of S1 is all sustainability-related risks and opportunities. And the second standard, S2, focus on climate disclosures, building on the same foundations of S1. For example, S2 fully incorporates the recommendations of TCFD, and it also sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and the industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as the SASB standards. These are organized by industry, enabling a company to identify climate-related disclosure topics and the metrics applicable to its business model and operations. Yes. And it's really important to know that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. As one also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in the 4 content areas, and connections between sustainability-related financial disclosures and the main financial statements. Okay, so next is time for an example. So over to you, Lois.
Thank you, Bella. And this example is about connectivity that Bella's just mentioned. Before I describe it, though, may I remind you of the disclaimer that Fiona gave at the start of our session today, which is that any examples that we share with you are really designed to inspire and illustrate certain points. Some of the examples we show you were developed at a time when the standards were quite new, so we can't say they're best practice. They're there to illustrate and inspire you. So let's look at this example from BHP's 2024 annual report about connectivity, and BHP is a global mining company. And this extract illustrates connections between the company's decarbonisation strategy, its financial results, and other processes. The company has undertaken climate-related risk assessment and scenario analysis. But rather than just looking at that in isolation, they consider the implications of those exercises for their business and their capital allocation plans. So the first paragraph tells us that the climate risk and assessments and scenario analysis are integrated into both the company's strategy and treated as a sensitivity in their capital allocation process. So they show the connections and alignment between the company's capital allocation plans and their sense of the rapidly decarbonising global economy. In the second paragraph, they tell us that there are some assessments that are still in progress, in particular physical climate risk assessments, but they inform us that they're going to use those results to inform the company's risk profile, corporate planning controls, and adaptation measures. And the pale grey text at the bottom of the extract shows us where we can find further information about how the impacts of climate-related risks are taken into account when thinking about operational activities, GHG emissions across the value chain, the financial statements, and production, revenue, and expenditure. So lots of connections and references to places where we can look at more connections. So we'll hand back now to Bella to take us through the next Zoom poll.
Thank you so much, Lois. Yes, as Lois said, it's time for another Zoom poll. Okay. So what information should be considered for connected information? Is it connections between governance strategy, risk management, and metrics and targets? or connections between sustainability-related financial disclosures and financial statements, or connections between sustainability-related risks and opportunities. And select all that apply. Let's wait for a few seconds to get more participation. Yeah, so I'm going to end this Zoom poll and share the results. Well, yes, you can see the results that were 50% selected the first option, and 62% select the second, and 36% select the third. Well, the correct answer for this Zoom poll is all of them are correct. Remember what I just introduced in the conceptual foundation. It's really important to note a concept that connected information or connections. So connections include all three aspects. So the first one for content areas, and second one sustainability related financial disclosures and the financial statements, and third one sustainability related risks and opportunities. Those are all connections that we should note. So now let's continue with the presentation. Yeah. So the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The SASB standards were used to create the industry-based guidance accompanying S2, and the FSA credential was also updated with more planned to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. So let's take a few minutes to go through the next Zoom poll. Water is a vital input to your business, but the SSB standards do not currently have a specific standard on water. What do you do? So is it, are you going to don't disclose anything about water or consult the sources of guidance listed by SSB? Or engage a consultancy to help? Or copy your competitors' reporting? So let's wait for a few seconds. Okay. So I'm going to end the Zoom poll and share the results. Well, yes, you can see from the results that 63% of participants choose the second one, consult the sources of guidance listed by SSB. Yes, that's the correct answer, and you've done a great job in this Zoom poll. Yes, as you can see from the question, that water is a vital input to our business, which means water-related information should be material information for your sustainability-related financial disclosures. So, even where the SSB hasn't yet issued a topic-specific standard, that doesn't mean companies ignore the issue if it is material. Instead, the standards explicitly allow and expect companies to look to other relevant sources for guidance. For example, CDSB water guidance, including industry standards and frameworks, to identify and disclose material sustainability-related risks and opportunities. So for these questions, option B is the correct answer. But sometimes you may find helpful if you engage a consultancy to help and copy your competitors' reporting. So let's move on. It's time for Fiona for the module 1 summary.
Great. Thanks so much for that, Bella. So before we wrap up this module, we'll take a couple of minutes now to review what we've covered so far. So firstly, we started by looking at the purpose of sustainability disclosures. And I think a really key takeaway we're hoping that you'll get from today's training is the understanding that there are important benefits, both internally and externally, for collecting and disclosing sustainability related information. So ultimately, if you're not aiming to make good use of that data that you're disclosing to improve your own strategic decision making, you're really missing an opportunity here. And also, if you are in a high impact sector or perhaps have difficult to abate emissions activities, it could be that your competitors are already disclosing those risks and identifying opportunities that they're pursuing. And that will then leave your investors wondering why it is that you're not managing those issues yourself. And that could start to affect your ability to access capital and your equity valuation as well. And then after that, we moved on to looking at the evolution of disclosure standards and the formation of the ISSB with that aim to simplify the reporting landscape. And when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, Bella introduced us there to the standards themselves and the important concepts that you need to understand in order to use them correctly. And a key point to reiterate here is that the standards and the guidance that come with them are designed to meet the needs of investors. So they are heavily focused on those prospects that we discussed at the start of the training regarding effects on financial performance and position as well. Okay, as we wrap up this module, let's do a quick exercise together to reflect on what we've learned so far. So this activity is just to get us to reflect a little bit as we're starting to think about how we would build our own organization's disclosure plan and think about what would be the objective of your sustainability disclosures. So I think what's important here is it's good to have clarity internally on what you're trying to achieve through reporting, because I think that will help you then to not just meet compliance requirements, but really to understand how you can maximize the value of that information that you're collecting and reporting. So in setting your objectives, you'll want to be clear about the particular disclosure requirements you're aligning with. And maybe you want to also think about what could be missing from your current disclosures. You know, what is the level of change that's required versus where you are currently? So let's go back to Menti now and we'll have a look at that together. So the link is there in the chat if you need it again. It's the same as before, but you can follow that link if you do need to get back into Menti. But let's see. I see a few people have responded so far. So feel free, as I said, just to share in a few words, maybe what your organization's objectives are, do you think? So what do you think is the approach that you would want to take to your sustainability disclosure plan? And maybe if you're not in the direct capacity of deciding on the organization's disclosure approach, maybe you could think of what you think it could be for an organization that you work with, or what your colleagues might say it would be. So I'm still seeing regulatory requirements coming up a couple of times. So indeed, of course, compliance we know was something that many of you mentioned, but of course the objective here if we can, is to get more benefits out of this process than just being compliant as well. So let's see, we had another response come in here. Let me just make that a bit bigger. So sustainability disclosures would promote transparency, accountability, and stakeholder trust by reporting ESG performance, tracking progress, and demonstrating our commitment to sustainable growth. Yeah, I think that captures some of the other aspects here, you know, transparency, building trust, enable you to track your performance, demonstrate a trajectory towards a more sustainable value creation model. I think those are all good points. We see investor protection. So maybe your investors are interested in particular in this, and also protecting the value of the company for them as well. Demand from your sector, yes, and maybe you work in a particular sector where your peers are already addressing these issues, and you want to make sure that you're keeping pace with them. So that could well be an important thing then, to compare your practices and, you know, benchmark against your peers to understand what you might be missing. Someone else has mentioned cash flow access to finance cost of capital and environmental impact. So both of those points perhaps. So indeed, thinking actually about the financial benefits and opportunities there may be from more disclosure here is definitely a good thing to highlight, I think, to your leadership for sure, to see that, you know, that is a potential benefit from this. I see strategic value, demonstrating how ESG integration mitigates operational risks. Yeah, exactly. So if you can really show how you're taking those risks and opportunities you're disclosing, and thinking strategically about how they impact your business model, that's definitely hopefully going to lead to some good outcomes for your organization's overall resilience. Clarifying risks and opportunities again, maybe meeting the expectations of stakeholders. I think decision making is an important word here as well. So indeed, making sure that you don't just put out information that you don't then reflect on internally, but actually use that internally to inform your organization's decisions. Okay, let's scroll down a little further. Thanks everyone for these responses. Someone's mentioned around aligning to global standards as well. So indeed, you know, if we have a globally consistent approach to these topics, it supports comparability, consistency, the ability to track progress globally on these things, and that's certainly very useful to investors. As someone's highlighted here, they might also seek to use the GRI standards if you want to report on the impact materiality lens as well. So we'll go into a little bit more about the connection between ISSB and other standards later as well. Improving transparency is coming up again. Let's see if we can see anything different. Showcasing the sustainability of the organization in the industry to investors. Yeah, definitely. So, you know, I think that also, I think, is important for the balance here. So actually both showing to investors the potential opportunities that you see from sustainable business practices is important. But equally, if you're actually being transparent with them and showing that you understand the risks, and are making steps to transition and manage those, I think is important as well. Okay. Someone's mentioned preparing for future reporting requirements as well. So that's a good point. You know, you can have a lens to current regulatory compliance, but also thinking about being prepared for what could become mandatory in future, or what you might anticipate seeing more demand from investors for, is a very good idea. Great. And I think some similar points here, but well summarized. So thanks everyone. I think you've all captured some really good points here that we would definitely highlight. So I think you know, the key points I think that you've got across here are really relating to those benefits beyond just compliance. You know, making sure that your investors really understand how you're approaching these issues, and you're keeping in mind at the forefront that investors are your audience here as well. So it's great to see so many of you highlighting that investor perspective in your responses. Fantastic. Okay, so let me just check where we're up to now. I believe it's going to be back to Bella, so I'll just get the slides back up while I pass over to you, Bella.
Thank you, Fiona. Yes. So let's continue with the slides. Okay. Oh, that's one. Okay. So here now we have introduced the initial concepts. Let's dive into how to apply the ISSB standards. taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. Okay. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures fit. To begin, let's focus on how to apply the SSB standards as the global baseline. Let's get started on the first core content area, governance. This aspect is centered on understanding how oversight for sustainability-related issues is providing in the organization through the processes, controls, and procedures that have been put into place at board or management level. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities? And is management responsibility delegated to a specific role or committee? And you can also ask internally how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to management sustainability-related risks and opportunities. And you may also ask whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full SSB standards. So next slide. So it's time for Lois to go through examples for you to better understand the standards requirement. Over to you, Lois.
Yes, thank you, Bella. And these examples that we're going to look at are about governance. And remember that every company will have a slightly different governance model. This example is from Yara, which is a global crop nutrition company, very big company with 17,000 employees in 60 countries. In this governance model example from the sustainability statements in the integrated report, we see that Yara has a highly integrated model with responsibilities for sustainability embedded across relevant business functions, including risk management, health and safety, environment and quality, HR, and global climate and energy. So let's look at the dark brown boxes in the middle. This shows the board of directors and president and CEO. On the far left, we see the board audit and sustainability committee, and their job is to assist the board of directors in overseeing processes for and internal controls of sustainability reporting, material impacts, risks, and opportunities. Then we can see the sustainability governance team and the pale green boxes in the middle of the slide, and they have a direct reporting line to the Chief Financial Officer. That sustainability governance team are responsible for sustainability performance and reporting, and their work is closely aligned with the corporate performance and risk functions. Then right at the bottom in the pale beige box, we have the Sustainability Network, and this reviews Yara's accountability processes and the systems they have in place for environmental, social and governance policies, and they monitor sustainability performance, and their network is chaired by the Chief Compliance Officer. The arrows here are used to indicate the flow of information and input between different governance bodies in the organization. So an integrated model. Let's look at one more example now, and this is from Petronas, which is Malaysia's national oil and gas company and a global energy group with presence in over 100 countries. In this example, the governance structure shows the executive, non-executive, and independent roles of the board of directors and the 3 committees to which the board delegates authority, responsibility, and operations. Now, note that in this case, climate-related matters are included in the responsibilities of all 3 board committees. The Audit Committee monitors climate reporting, and they provide assurance on the state of governance controls and compliance in relation to greenhouse gas emissions monitoring. In the middle, the Nomination and Remuneration Committee reviews the President and Group CEO's performance scorecard, which includes climate-related measures. And then we have the Risk Committee, and their work includes looking at climate-related risks and mitigations. At the bottom, you'll see that there is an executive leadership team, and their duties include sustainability. They also report to and assist the board. So here we have another integrated structure like the one we saw in Yara, the previous example, where responsibility for climate and sustainability matters are embedded across multiple functions. And this structure provides role clarity and accountability, promotes strategic alignment across the group, and facilitates decision-making at all levels. So we'll now hand back to Fiona, who will take us through the strategy content area.
Thanks, Lois. Great. So hopefully those examples have helped to make governance content requirements fairly clear. So looking at strategy, there are more disclosure requirements here, but we do also think it's where companies can really start to see the benefits from sustainability related opportunities and being better prepared for the risks. So this content area focuses on really understanding what the company's strategy is for managing its sustainability related risks and opportunities. And so there are 3 high-level areas that we'll focus on here, which are risks and opportunities, their effects, and then resilience. So we'll take a look at each of those in turn now. So starting with risks and opportunities, the disclosure requirements are really kind of focused on understanding fundamentally what are the company's risks and opportunities that it's identified that could reasonably be expected to affect its prospects. And so if we look at the questions we have on the screen here, this shows us some of the things we'd want to start asking ourselves when we're preparing to disclose information on this topic. So the information required will include a description of what the risks and opportunities are, the effects that might be expected on the company from those risks and opportunities, and the time horizons over which those effects might be expected to occur. And this is where we should also keep in mind that financial effects could occur before a risk or opportunity materializes, or afterwards, or they could change over time, if you remember going back to what we talked about on that front at the start of the session. And when we're looking particularly at climate change and the requirements in the IFRS S2 standard, there are some specific aspects to consider here as well. So, for example, S2 requires companies to use the climate-related risk categories developed by the TCFD of physical and transition risk. And both of the S1 and S2 standards here provide accompanying guidance to support companies to identify and disclose material information about risks and opportunities. And they also recommend making use of industry-based guidance and the SASB standards. So let's have another example here to look at what a disclosure of the overall summary of risks and opportunities could look like. So this example comes from Mondi Group's integrated report. So Mondi Group is a packaging and paper company operating across Europe, North America, and Africa. So in the left-hand side of the extract, we can see a summary of the overall risks that the company has identified and how those risks align with 4 key categories. So strategic, financial, operational, and compliance risks. And they've also identified the delegated risk owners for each of those individual risks. Alongside this summary table, the report also includes a lot of information to describe each of those risks more specifically and the expected effects of the risk, or potential effects as well, I should say. And then as climate change is identified as one of those strategic risk categories on their principal risks, in the second side of the disclosure on the right-hand side, they also go on to disclose those categories of specific physical and transition risk and climate opportunity that they expect could be potentially relevant for them. And so, as well as identifying the risks through an evaluation process described in the report, they also provide disclosure on the estimated financial impact ranges and time horizons of these risks, as well as thinking about the sensitivity of the risks and opportunities in terms of their likelihood under different climate scenarios. And so another aspect of those risks and opportunities identified as potentially affecting the company's prospects that will need to be disclosed brings us back to what we talked about at the beginning of the session regarding time. So you might remember I mentioned that time can be a slightly different factor when we're thinking about sustainability related disclosures. And so the standards ask that you identify over what time horizons the effects of each sustainability related risk or opportunity could reasonably be expected to occur. But how the company defines short, medium, and long term horizons will vary, and it will depend on a number of factors. For example, consideration should be given to things like the investment and business planning cycles, the strategic planning horizons of the organization, the assessment periods used by its investors, perhaps the lifespan of its assets, for example. So what's important to keep in mind here is that you do need to clearly define the time horizons you're using when you're disclosing your risks and opportunities. So you won't necessarily expect that your investors know what you mean by short and medium term unless you give them a clear definition of that. So moving on then to the second group of disclosures in this category. So firstly, we started by identifying the risks and opportunities. And this next set of disclosure requirements focuses on disclosing exactly what the effect of those risks and opportunities are and where those effects are expected to occur in the business. And so to start tackling the disclosure requirements here, companies would want to start by asking themselves questions such as, what are the effects? Where would they expect them to occur? And what current responses do they have planned to mitigate or adapt to these risks and opportunities? Or perhaps what measures could they put in place in the future? So we'll have another look at an example again here. So this one comes from the chemical company BASF's annual reports. And it illustrates some of the projects that form part of the company's sustainability strategy, which they call winning ways. The strategy includes supplying customers with products that contribute to sustainability through the use or reduction of their carbon footprint. And we're seeing that the company is prioritizing projects where they're seeing a rising demand from customers and potentially a willingness to pay more for sustainable products. As well as this, they're also focusing on transformation projects that support the company's own license to operate and reducing its direct impacts and risks as well. Among other things, the company is investing in renewable energy to operate their plants, which you can see in the own production panel in the middle of the extract. They also refer on the downstream side to what they call their triple S approach, which is their sustainable solution steering. This is all around pivoting the company's portfolio to support their climate targets and also supply those products to customers that are more sustainable. And what we see here really is that the company has evaluated the different areas that sustainability cuts across its value chain and its direct operations. And it's responding to that by taking action across those different areas to manage potential effects on its business model. They talk really as well in commentary alongside the report around their objective to increase their sales revenue by 2030 to 10 billion euros coming from projects that contribute to sustainability and a circular economy. So you can kind of see there the ambition that they're setting themselves to really pivot and realize the financial opportunities of more sustainable product solutions. So we know that one of the obstacles that companies could face when they're reporting on the effects of these risks and opportunities is to understand what type of detail needs to be disclosed, and in particular, whether this information needs to be quantitative or qualitative. So in those examples that I've shared with you so far, we've seen mostly qualitative information, but we did see a little bit of quantitative information. But what is the approach required under the ISSB standards? Well, a company is asked to disclose both quantitative and qualitative information about financial effects of sustainability risks and opportunities. However, the standards do provide a number of criteria for when providing only qualitative information is required, or perhaps a mix of qualitative information. And these include if a company cannot separate the effects of a sustainability related risk or opportunity from other effects. So maybe there's a number of issues that have been identified that could lead to a similar financial effect, and it's not possible to isolate the specific effect that may be expected or potentially anticipated from that sustainability issue. A number of other reasons include if there's a high level of measurement uncertainty, so it's just not possible to measure the effect. And finally, if the company doesn't currently have the skills, capabilities, or resources to enable it to provide that quantitative information. However, overall, of course, if a company does already have quantitative information that it feels is material to disclose, then of course it should be reporting that. So that brings us now to the last part of the strategy component, which is resilience. So really here we're getting into the practices and processes that the company has in place to assess its strategic resilience and make potential adjustments where it needs to. And so the disclosure requirements here will include information on how resilience has been assessed and over what time horizons this analysis has been conducted. And when we're talking about climate-related issues, IFRS S2 additionally requires the use of climate-related scenario analysis, using an approach that's commensurate with the company's circumstances. So the required disclosures on the climate side will include the results of the assessment of climate resilience and a summary of the key inputs and assumptions that have been used to conduct that assessment. So we'll dive deeper into scenario analysis in a moment, but some of the questions that you could consider asking internally when you're starting to disclose on this would focus on understanding what the company's capacity is to react or adjust to any potential uncertainties it's identified, and how different scenarios could be used or have already been used to better test and understand this. So looking at another example here, this one comes from Stora Enso, which is a Scandinavian forest products company. And these diagrams show us a bit of a summary, really, of how Stora Enso has identified the need to pivot its business model into the future and some of the potential scenarios it sees playing out. So in particular, they're showing that they expect that their core business model, which relates to forests, pulp and paper products, potentially is going to see declining revenues in the future. And so to off this, they've identified a number of activities to support their growth strategy, which connect to sustainability. So these include sustainable building solutions, renewable packaging, and biomaterials as well. And in the bottom part of the disclosure, they've shown a breakdown of how they expect potentially their sales revenue could change over time, such that these growth areas make up a larger share of their future revenue, kind of offsetting some of that possible decline they could see from their more traditional business areas. And in the commentary that sits alongside this, they explain some of the actions they're taking now to respond and adapt to this. So, for example, acquiring new businesses with relevant technologies for the growth areas, and also investing in innovation and converting their existing machinery as well. And just a second quick example for you here comes from Marks and Spencer's, which is a British multinational retail company. And this is a summary of their climate-related risks and opportunities and the particular impacts they're expecting, or effects, I should say, from these risks and opportunities on the company's business, strategy, and financial planning. So there's quite a lot of detail here, I know, and I'd recommend looking at these examples in the slide handout after the session, or following the links to look at the reports in detail as well if you'd like to look at them more closely. But just to highlight a few key points coming out of this. So in the first column there, they describe the risk and opportunity. And then they explain in particular which parts of the business they're expecting could be affected by that risk and opportunity, and the time horizons over which they're expecting those effects to occur. They then also go on to provide us with a bit more detail about the types of potential financial impact they see on the business, and explain as well in the notes where they've been able to quantify these issues and perhaps where they have not been able to quantify them currently. And they also provide some references where further information about capital expenditure costs relating to these issues can be found in the financial statements. And then in the final column, they give details about the business's response to those risks. So this could include things such as reviewing shoppers' sustainability preferences, investing in new product development, and developing targets that respond to these particular risk areas as well. Okay, great. So just to finish off this segment now, let's have a final poll question, which just tests one of the things I talked to you about a couple of slides ago, just to see if you can remember those points. So if you remember, we discussed the criteria under which it would be acceptable for companies to provide just qualitative information or a combination of quantitative and qualitative information about financial effects. So more than one of these might be right, just to give you a clue, but let us know which of these you think is an acceptable reason for disclosing qualitative information about the financial effects. Give you all a few seconds to have a read of those before we have a look at the right answers. Okay, don't worry if you get the polls wrong as well. It's good, I think, to engage your brain and have a little bit of a guess and reflect on these things. So we always like to see as many people taking part as possible. At the moment, we have just 50 of you responded of 174 people here. So it'd be great to get a few more answers, and the same regards inputting to our mentees as well. Okay, I'll give you a couple more seconds. Almost half of you have taken part. Let's end the poll there then, and I'll share the results with you. So it looks like those of you who responded got the first option right. Indeed, that's correct. That is an acceptable reason. The second option as well was also a correct answer if there is a high level of measurement certainty. However, as most of you identified, the final option there isn't a correct answer, because it is, of course, important that when we're being reporting in our disclosures that we're transparent to our investors about both positive and negative impacts. And indeed, in the examples that we have included in the slides here, if you look at the detail of those, you will see that those companies are disclosing financial effects for both risks and opportunities. So important not to hide negative information in that respect. Okay, great. Thanks, everyone. So I'll pass us back to Lois now, who's going to look at some of the climate-specific aspects of this content area.
Yes, thank you, Fiona. With the strategy content area, there are some climate additional requirements. So we're going to look at those now. So as we said earlier, the disclosure requirements in IFRS S2 built on the TCFD recommendations, but we're going to go through a list of the points that are climate specific on strategy here. First of all, S2 requires companies to use industry-based metrics. and requires a company to refer to and consider the applicability of industry-based topics in the industry-based guidance and for the purpose of identifying climate-related risks and opportunities. So as we've discussed, these are the 77 standards that cover different industries and show what is most material for those industries. Secondly, S2 requires information about where in the business model and value chain risks and opportunities are concentrated. So, for example, there might be particular installations that are particularly at physical climate risk, and that those details should be disclosed. S2 requires companies to provide detailed information on the effects of climate-related risks and opportunities, including how a company has responded to or plans to respond to identified risks and opportunities. And if one of a company's responses is to develop a climate transition plan, then it is required to give details about that and details of how it will achieve any climate-related targets as it has set. In providing disclosure about the current and anticipated effects of risk and opportunities on the company's financial position, performance, and cash flow, S2 sets out criteria for when quantitative and qualitative information is required. So disclosure of qualitative information only is permitted in some circumstances, and it's actually some very good educational material available on the ISSB's website about disclosure of anticipated financial effects. And they explain that qualitative information is required, for example, where a company cannot separately identify the effects of the risk or opportunity. So if a company sees that demand for its products is falling, this could be attributable to a range of factors, including general economic factors, changes in consumer demands, could also be partly due to climate change effects, but they may not be able to quantify the climate-related impact of that against the other types of effects. Similarly, if there is a high level of measurement uncertainty, then a company can provide qualitative rather than quantitative information about financial effects of climate risks. So moving on to the third bullet point from the bottom, when preparing disclosures about anticipated financial effects of climate risk, S2 requires a company to use all reasonable and supportable information available to it at the reporting date without undue cost and effort, and using an approach that is commensurate with the company's circumstances. We'll look at that phrase in a bit more detail later. S2 requires a company to use climate-related scenario analysis when assessing its resilience to climate-related risk, but does not specify the particular scenario to be used. And also S2 requires information to be provided about climate resilience, including any specific or significant areas of uncertainty the company's considered, what its capacity to adjust and adapt its strategy and business model is over time and to remain resilient. And also the details must be required about how and when scenario analysis was carried out and which scenarios were used. Now, I mentioned earlier that if a company's response to climate risk is to set a transition plan, then it must provide details of that plan. It's not a requirement for a company to set a transition plan, but if it does, it must provide the details that are details about it. So what are transition plans? Well, they're an aspect of the company's overall strategy that includes targets, actions or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions plans. So what should a transition plan be like? Well, first of all, it should align internally with the company's strategy, business case, business motivation, for addressing climate change, and should show decarbonisation levers that are most economically and technically feasible for the company to use. And of course, this alignment is necessary because the transition plan is an aspect of the company's overall strategy. Secondly, it should align with the goals of science. Thirdly, it should set out long-term goals that are consistent with science, perhaps, with the company's objectives, should set out clear mitigation and adaptation activities, and should include interim targets and milestones. The transition plan should be transparent about what types of dependencies, risks, and challenges they anticipate that could affect the execution of the transition plan, and also include in their explanation how residual and unabated greenhouse gas emissions will be handled. Now, the climate transition will proceed in different ways for different sectors, and therefore sector-specific pathways should inform the development of the company's transition plan, and we'll look at some resources for that in a moment. And finally, the transition plan will be evaluated by investors, and companies should ensure that it has the hallmarks of credibility, which are set out in the Sustainable Stock Exchange's guidance on transition plans. And we're actually going to look at some resources now. So I've just mentioned the SSE's model guidance on transition plans, which does set out a list of hallmarks of credibility of a transition plan. In the triangle on the left-hand side, you'll see that the resources we're describing are all designed to support each other. So the work of GFANZ, the Glasgow Financial Alliance for Net Zero, is designed to support the IFRS Foundation recommendations, as is the material of the Transition Plan Task Force, which the IFRS Foundation assumed responsibility for. So all these pieces of guidance you see here support each other. You have a guidance document on transition plans from the IFRS Foundation. I think that's less than a year old, so do have a look at that. We also have sectoral pathways set out in the work of GFANZ and others, including the Mission Possible Partnership. And also please refer to the work of the Transition Plan Task Force, and their materials are available on the ISSB website, and their materials as well. So I can see that some of you have asked for a break, and I don't blame you. The break is now upon us. I'm afraid it's only 5 minutes. So we're going to take this short break. We're going to play you some relaxing music. Please have a drink, have a stretch, think of any more questions you'd like to ask us, and we'll see you back here in 5 minutes. everyone, and welcome back. Hope you had a good break, albeit a short one. We're going to move on now to the third core content area of the ISSB standards, which is risk management. And this category of disclosures focuses on enabling investors to understand the processes a company uses to identify, assess, prioritize, and monitor sustainability related risks and opportunities, and whether and how those processes are integrated into the company's overall enterprise risk management processes. So the questions you might want to think about internally to gather information to respond to these disclosure requirements are: what processes and policies are being used to identify, assess, prioritize, and monitor risks and opportunities, and how and to what extent are they integrated into the company's overall enterprise risk management processes? Now, as a reminder, in the strategy content area covered by Fiona earlier, we were also talking about sustainability related risks and opportunities, but the focus there was on the risks and opportunities that could be reasonably expected to affect a company's prospects. So the nature of the risk, the type of the risk, the effect of the risk. These disclosure requirements in the third core content area are more about processes and policies. So as well as these questions, you might be thinking about which criteria you use for assessing the nature, likelihood, and magnitude of sustainability related risks and opportunities, and how they're monitored, and how any processes have changed since the last reporting period. Let's have a look at an example here about how BMW, which is the German car manufacturer, describes their risk management process. They use words and diagrams. So the company reports risks and opportunities for the current and subsequent financial years. Turning to the process, as summarized in the diagram, around the edge of the circle, we see the word appropriateness, and this refers to the risk culture embedded in BMW's core values. We also see the word effectiveness, which refers to the effective management of risks and opportunities. And in the words in the inset there in the text, they say that this effective management of risk and opportunity is the foundation of their business success. Down the left-hand side of the diagram in the red and blue circles, we see the group compliance and internal control systems forming key interfaces with the risk management system. So the process is not the responsibility of the risk department alone. Risk management is steered by a centralized risk management function, but it's organized globally as a decentralized network with different network representatives. So what does the process itself involve? And here we're moving into the light blue dials within the circle. It involves early identification of risks, analysis and evaluation of risks, using appropriate risk management and measurement tools, monitoring and assessment of the measures taken, and risk reporting. So all the material risks are reviewed by the Risk Management Steering Committee. You can see that in the white circle, and that is chaired by Group Controlling. And any material risks are then reported to the Board of Management and the Supervisory Board's Audit Committee. So when we look at climate-specific considerations on risk management, which we're turning to now, S2 requires that information is provided about the input parameters used to identify risks, whether and how scenario analysis informs risk identification, and whether and how risk management processes have changed since the last reporting period. And the same applies to climate-related opportunities. Now, when we talk about climate-related risks and opportunities, we actually have definitions of these terms in S2, and these are based on the recommendations of the Task Force on Climate-Related Financial Disclosure. So part of identifying risks is being aware of what risks and opportunities you should be evaluating to begin with. And these are defined as two main types, transition risks and physical risks. Transition risks arise from efforts to transition to the lower carbon economy, and they're often subcategorized as policy, legal, technological, market, and reputational risks. And we see some examples of this in the middle column. So they could be increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs associated with the transition to lower emission technologies, transition risks associated with different consumer behavior and demand, uncertain market signals, changes in the cost of raw materials and in the quality of those raw materials. Similarly, physical risks can be subdivided into acute physical risks that arise from weather-related events such as storms, floods, droughts and heat waves, which we know are increasing in severity and frequency. Or they can be chronic physical risks that arise from longer-term shifts in climatic patterns. So this could be changes in rainfall and temperature, sea level rise, reduced water availability or quality, biodiversity loss, and changes in soil productivity and quality. And in both cases, these risks can give rise to financial effects that affect the cash flows, access to finance, cost of capital of a company, and those financial effects can manifest over different time horizons. Similarly, in S2, we have a definition of climate-related opportunities. So these can include, these are the positive effects for a company of transitioning to the lower carbon economy. So this can include improved resource efficiency across value chains, changing to lower emission sources of energy, developing new products and services that respond to different consumer demand, perhaps, or use new technologies, accessing new markets, and increasing resilience through access to new markets and differentiation against competitors, or being able to substitute resources or diversify resources. And again, these opportunities have financial effects on cash flows, access to finance, and cost of capital over different time horizons. Let's have a look now at an example of how the RS Group, which is a UK-based distributor of electrical and industrial equipment, with global operations, let's have a look at how they make disclosures about their physical climate risks and the processes that they use to monitor them. So here we're looking at an extract which is about the physical climate risks. And this follows pages in which the company set out the fact that climate is one of their 10 principal risks. So this is just an extract about the physical risks. The most significant physical climate risks for this company relate to the impact of extreme heat on their distribution centres, that's on the first line, and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations, that's on the second line. We can see little red wheel icons that show the strategic effect of the risk on the company's operations, and there are icons that also show the effect of risk on connected stakeholders. So they're connecting the risk to the business strategy and to their stakeholders. In the columns that follow, we see the description of the risk, who is the business owner of the risk, i.e. who's responsible for managing that risk, what metrics are used to monitor the progress of the risk, and in the final column, what actions are being taken to respond to the risk. So these include things like building upgrades, capital investments, and business continuity plans. So there's as well as a current focus, there's a future focus. And elsewhere in their report, they disclose information about the projected financial impacts of these risks under different climate scenarios. So we've covered risk management now, and we're going to go back to Bella to take us through the next core content area.
Thank you, Lois. Yes, okay. Yeah, thank you, Lois. So, as Lois said, it's now the time for the last one, metrics and targets. And we will now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. Disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. So let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. What is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? Now let's move on to the second part, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals, as well as any targets it is required to meet for regulatory purposes. So disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And disclosures also include the metric used to set target and to monitor progress towards its achievement, the baseline period from which this progress is measured, and the period to which the target applies. And also is required to disclose what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. So to better understand these requirements, it's time for an example. So over to you, Lois.
Thanks, Bella. And this example comes from CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. Now, you'll have noticed that many of the examples we've shared with you up to now have been about climate change. Here we have one that shows waste management and material use metrics for 2024 in this case. So the company is measuring the percentage of pollution the company reduces through recycling and removal activities. And this is in line with its strategy, its circular economy strategy, and other principles it uses for its business. Now, they're measuring waste management and material use, but you might be thinking, well, we don't have an ISSB standard on this yet. No, we don't. Companies are required to make disclosures about all sustainability related risks and opportunities, though. And you'll see in that first box that the way the company has calculated their waste management and material metrics is in line with the SASB and GRI frameworks, and we'll come on to see that that's absolutely the correct thing and fine thing to do. So the other thing to note about this is that we have the targets as well as metrics. We have targets set here. So the company had a 2021 base year. They've set targets for 2025, and they show their progress as at 2024. So back to you, Bella, for more about metrics and targets, please.
Thank you, Lois. Yes, so next one, let's talk about some of the climate-specific considerations for disclosures on metrics and targets. In relation to metrics, IFRS 2 requires a number of specific disclosures, including S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and the associated joint ventures, and information about companies' financed emissions. In addition, IS2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IS2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, IS1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE's website. Okay, as for metrics, there are some climate-specific disclosure requirements in IS2 for targets as well. For example, IS2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. IS2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And IS2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Questions on GHG emissions often come up in questions on metrics and targets disclosures. So we wanted to address some of this briefly. For those who might not be familiar with different scopes, I would like to introduce a little bit. So Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And the Scope 3 is all other indirect emissions that occur in the company's value chain. So IS2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. IS2 also requires a company to disclose whether and how the company is using an internal price on carbon for decision making, and whether and how executive remuneration is linked to climate-related considerations. On the 29th May of 2025, the IFRS Foundation has published a new educational material presented in a Q&A format, detailing the greenhouse gas emissions disclosure requirements under IFRS S2, including measurement, use of the GHG protocol, and how to report Scope 1, 2, and 3 emissions in line with the standard. Yes, over to you, Lois. Time for example again.
Thanks, Bella. And this diagram shows how the company Vale, which is a metals and mining company, reported their greenhouse gas emissions in 2024. It's an extract only. So the tables on the left show greenhouse gas emissions broken down by scopes 1, 2, and 3, as well as comparative figures going back to 2022 and to the baseline year in which greenhouse gas emissions were set. The circular diagram on the right of the screen shows greenhouse gas emissions broken down by source. So mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. So this gives the reader an impression of where the greenhouse gas emissions are coming from, as well as the differentiation between different scopes of greenhouse gas emissions. Notes and symbols used in this extract tell us how the results have been prepared, and the inventory was prepared using GRI's greenhouse gas emissions standard, GRI 305. We also hear that the GHG inventory has been assured by a third party. They note that in note 1. And note 2 tells us that the greenhouse gas emissions have been reported on a gross basis before any type of compensation, and that's what's required by the ISSB standards. At the bottom of the page, there's an overview of the company's long-term commitments on climate change. So they tell us that the baseline for their scope 1 and 2 targets, what the reduction target is, that's 33% by 2030, and they aim to achieve a net zero emissions by 2050. They also show us what progress they've made towards their target. So they've made 81% progress towards the target in 2024. So quite a lot of information giving us a breakdown of greenhouse gas emissions in that little extract. Let's have a Zoom poll now. And the question is, what is the objective of metrics? In particular, what's the objective of the disclosure requirements about objectives in the ISSB standards? You can answer all that you think are applicable. Thank you for your participation. In the interests of time, I'm going to share the results with you. Yes, the majority of you said A and B, and you're correct. Now, the reason we've asked you the question in this form is to encourage you to read the ISSB standards, because at the start of every core content area, there is a statement setting out the objective of the disclosures. And the objective of the disclosure requirements on metrics is to understand the company's performance in relation to sustainability-related opportunities and risks, and to understand progress towards any targets. Now, the readers might also gain information about how to understand the company's assumptions for the future, but A and B are the objectives as set out in the standards. So do have a look at the standards themselves. It will help you to craft your disclosures more in line with the objectives of the core content areas. So we're going to move on now to the next module, which is about additional disclosures, and that is how you integrate other disclosure requirements, that's other than the ISSB disclosure requirements, that you may wish to comply with. So we've already talked about the baseline. You know that this is the baseline that sets a common language for sustainability information set out in the standards. But in addition, there may be information companies want to or have to supply because of local listing requirements to meet policy objectives, because those disclosures align with emerging industry practices, or because the company wants to provide information for stakeholders in addition to investors. Now, this is all fine, and we've already talked about the fact that these standards from the ISSB are being adopted in multiple jurisdictions. So as at December 2025, and I think this has gone up now, 39 jurisdictions have adopted, used, or are finalising the adoption of ISSB standards. And the ISSB has issued, if you can see in the link we provide there, updates about how they're getting on with working with jurisdictions for the adoption of standards across the world. When you provide information in addition to the ISSB requirements, you might do that by reference to some of the standards and frameworks and questionnaires that we have already discussed. So we've already said that the CDP has aligned its climate questionnaire with the ISSB's standard. And we've talked about how the GRI and Transition Plan Task Force are working with the ISSB. In addition, the greenhouse gas protocol, which is the protocol that must be used for the calculation of greenhouse gas emissions, the greenhouse gas protocol team are working closely with the ISSB, both in terms of governance and technical matters, to ensure alignment between the GHG protocol's work and the ISSB standards. And those of you that follow the ISSB's news will know that the ISSB is working on a nature-related project at the moment to provide material on nature-related disclosures. So lots of activity to support interoperability between the global baseline and other frameworks. The GRI, as we've said, is working closely with the IFRS Foundation to jointly identify and align common disclosures. Now, one particular specific piece of information is that in June 2025, the GRI's Sustainability Standards Board, or GSSB, granted equivalence to IFRS S2 climate-related disclosures on Scope 1, 2 and 3 greenhouse gas emissions. So this means that companies will only have to measure their greenhouse gas emissions once for the purposes of responding to GRI or the ISSB. That's what it means in a nutshell. The two organisations are collaborating to deliver full interoperability in terms of biodiversity, ecosystems and ecosystem services disclosures. And they also work on governance matters, such as they were the joint convening partner of GRI's Sustainability Innovation Lab in Singapore. There are some specifics if you intend to use GRI or ISSB standards for your greenhouse gas emissions reporting, and that's dealt with in the statement that we've linked to on the slide there. I don't think this is so much for this audience, so I won't cover it in detail, but you probably know that in Europe, companies are required to make disclosures using the European Sustainability Reporting Standards under the Corporate Sustainability Reporting Directive. Suffice it to say here that the IFRS Foundation is working very closely with the European standard setter to ensure as much alignment as possible. The ESRS standards have been through a process of simplification, but as at today, we know that there is already a high degree of alignment between the two organisations' requirements on climate-related disclosure. At the beginning, we mentioned that the Integrated Reporting Council has been integrated into the IFRS Foundation, and the Integrated Reporting Framework still exists and can be used as a complementary tool for investor-focused communications on sustainability disclosure. So there is a link to a guide there you can use if you wish to use integrated reporting to support your sustainability related financial disclosure. And perhaps the most important thing to say about integrated reporting here is that it's underpinned by integrated thinking, and this can very much support the quality of a company's corporate governance. I can see some of you asked about processes for supporting corporate governance, and the integrated reporting framework might be one such tool that you could use. So let's have a look at a Zoom poll now. And this asks you that when you are making your sustainability related financial disclosures, your objectives should consider the ISSB standards only, or the ISSB standards and regulatory requirements, or just regulatory requirements, or all of the above and other sources of guidance, and you can only pick one answer here. I'm going to share the result now because I can see that you know the answer. So thank you for listening so carefully. And of course it is D. When you are considering what to and how to disclose, you should consider the ISSB standards, regulatory requirements, and other sources of guidance. So well done for getting that correct. And we're going to hand back to Fiona now to take us through a summary of Module 2.
Thank you, Lois. Excellent. Well done, everyone. You're through our second module of the training. I know you're probably thinking, wow, it's already been a long session. Don't worry, module 2 was where a lot of the detail for understanding the content requirements sat. So we're well more than halfway through the content now. But hopefully that's been helpful just to really get into a good understanding of really what's required to disclose against the standards. So just reminding ourselves what we've covered. So firstly, we reviewed all 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. So although we might have walked through each of those as separate areas, of course, one thing that's important to remember here is that these don't operate in silos in a real world sense within an organization. And so, of course, we saw in our disclosure examples that despite these being 4 separate content categories, they're all interconnected in practice. And so those interconnections are an important thing to keep in mind for your own organization's approach. And then in the second half of this module, we also discussed how your disclosures might go beyond the requirements of IFRS S1 and S2, for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or perhaps to meet industry standards as well. And so what's important to remember here when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And that building blocks approach allows report preparers to add additional disclosures on top. But that's where we also need to be careful if we're going to do that in making sure that we don't obscure the requirements of S1 and S2 for an investor audience as well. But let's go back into a bit of an exercise now just to make sure everyone's awake and test our reflections on what we've just covered. So our next exercise is all around doing a gap analysis for your organization to understand what gaps you might need to address in your current disclosures or perhaps in your internal processes as well. And when we're coming back to that disclosure plan and the homework assignment to build your disclosure plan, this is one of the key things we'd recommend that you take away and do for your organization. And there's some tools within our resources that we've shared that can support you with this gap analysis. But when you're conducting a gap analysis, of course, we think it's really important just to work through a thorough understanding of where you're at currently against the disclosure requirements and what you might need to implement in order to meet the requirements of the standards. And this could include identifying a number of different things. Maybe you need to add particular content areas to your disclosures. Maybe you need to think about new topics that you haven't previously reported on. Or maybe you also need to think about your internal skill sets or competencies within your organization to respond to these requirements. Maybe how you adapt your processes to better prepare you to collect the right sorts of data. So what we'd like to do now is just take a moment together to reflect on, of course, we're not going to maybe have time today to think about all of the gaps, but maybe reflect on what do you think a key gap for your organization would be, or maybe organizations you work with if you're not directly a report preparer, just to kind of think about what's front of mind as key gaps based on perhaps what you've heard as we've presented the content requirements. Maybe something has come to mind for you already that is not in place within your organization or is not something you're currently reporting on that you would need to address. So let's have a look together. Thanks for those who've already shared, and do encourage you to join us in Menti and to share your thoughts if you haven't already done so. So someone has mentioned the absence of mandatory disclosure requirements means that existing disclosures could be voluntary, fragmented, or perhaps inconsistent. Yeah, I think that's a common place that many organizations will find themselves in, because if they've perhaps reporting on a voluntary basis, they may have used a mix of different standards, they may not have used a standard at all. And so you might have to go back and look at the structure a bit of your disclosures in the context of aligning with IFRS S1 and S2 to perhaps take a slightly more systematic approach to reporting in line with that particular requirements for the standards. And I see someone here is a regulator, so great to get your perspective on this as well. Of course, a slightly different lens, but as a regulator, you're seeking to strengthen consistency, comparability, and assurance of sustainability disclosures while enhancing internal monitoring, data quality, and stakeholder engagement processes. So perhaps for the preparers here, thanks for whoever's shared that, that's a good indicator there as to what your regulator might be looking to get from you in terms of disclosure requirements. So keeping in mind those types of points that they're looking for from your reporting, I think is a very good steer here. Someone else has mentioned data collection and assurance, also enhancing their value chain disclosures, thinking about climate change and cross-functional integration. I think those are all really articulately mentioned gaps there, and I think are common things that many organizations might see, of course, because the requirements to have perhaps more robust data collection processes and improve the quality of data does perhaps lead to a bit of a step change. Whereas if on a voluntary basis, we might have collected data perhaps in a slightly less structured way, as we're moving towards mandatory disclosure, of course, and possibly thinking about getting assurance over our information or ensuring it's a standard that could be assured, then yeah, definitely strengthening those data reporting processes. And as much as we can, as you say, building on what other functions are already doing regarding risk management, financial accounting is really important. Let's see what else we've got here. Some very good responses already. Thanks, everyone. So someone's mentioned maybe the lack of human capital resource to address different areas related to the standards. Yes, of course. So you might actually realize that there are capabilities that you don't have internally that you need to support this. And so there's a few things I guess you could consider there to address that. Maybe it's upskilling your existing staff to understand these topics better. Maybe, there's an identification of new hires that are needed in the team, or perhaps you could also work with an external consultancy to help upskill your organization as well. So a few things to consider there. Someone's mentioned about data and reporting, maybe strengthening the internal capacity and risk assessment mechanisms. Absolutely. So as much as you can build these sustainability requirements into those existing reporting processes or assessment processes, that's definitely a good approach to take. So thinking, in a structured way about maybe what's missing from your processes currently to enable you to collect and report the types of information you need is a very good starting point. Someone has also mentioned around the metrics side of things, definitely something that might be quite new for many organizations. So, mapping, I think, what data that you have already to support the disclosure of metrics is a good point to come to. It may be actually that there's more data that you have available internally than you think at the moment. It's just getting an understanding of where that sits and how it can be used. And we'll go into that a little bit more actually in our next exercise. Yes, okay. Let's have a look. So someone's mentioned the fragmented data across departments. Definitely. So they've mentioned production, procurement, HR, logistics. I think as well, that's likely to be something many other organizations are facing. And I think that, there may be different approaches needed for different organizations here. It might be that you want to start to centralize some of that information collection. Or maybe it's better actually that it lives within the different operational departments who utilize it for other purposes. It's just about ensuring that you have access to that and it's collected in a robust way that you can use for disclosure purposes. So exactly how you resolve that challenge is probably dependent a little bit on your organization's circumstances, but it's a very valid challenge to have highlighted. Let's have a look. Someone also mentioned gaps in governance as well. I think that's a very good thing to think about at this stage and think about how you can address, because I think governance is a really important foundation to a lot of these other things we've talked about addressing here. So ensuring that you have clarity of remits, that you have, an oversight channel to talk about this is another important topic as well. And we've developed some recent guidance actually on ISSB for boards, which we'll share with you in the chat, which I think could be a useful review source there to talk about how you can build better governance around these disclosure practices. Great. Someone also mentioned the awareness of the board members. So it seems like that's something others are seeing. Maybe we've seen a few people mentioning as well regulatory and standards differences across markets, and how to navigate that. So that's definitely, I think, an important point to highlight as well. Unfortunately, there's no silver bullet at the moment. I think hopefully this building blocks approach that we've talked about here of using the ISSB standards as your baseline to give a good structure to your reporting and thinking about additional disclosures on top of that can support you here. But some of the materials that we've shared, the resources to map these things, hopefully can support you there in better navigating some of those considerations as well. Lovely. Thank you, everyone, for the good answers here. This is useful to have. I think we've discussed quite a lot of these areas as well, but maybe this comment here is useful to highlight as well. In the climate and scenario analysis elements are often perhaps the more detailed technical aspects that many organizations have to get to grips with. So again, I think a common position to be in. I think hopefully some of the proportionality mechanisms and transition reliefs that exist within the standards also offer support here, to phase the approach as you build your maturity to respond to those particular requirements. Thank you, everyone, for highlighting those. So, of course, understanding the gaps is one thing, but thinking about the action points is another key consideration. So, what we'd encourage you to do is to build on some of the reflections you've already shared there, and work through perhaps a bit of a gap analysis with your colleagues internally so that you've got a clear understanding of, what you need to do to align with the standards, and perhaps you can start to build some actions from that. So I'll share in the chat with you as well the resource that exists from the SSE to support you in doing a gap analysis that you could use to help you with that exercise internally as well. Okay, but that brings us up to the end of Module 2. Back over to you now, Lois, for Module 3.
Thank you, Fiona. So up till now, we focused in this training on what to report, what are the disclosure requirements, what must be reported. We're now going to turn to look a bit more at practically how this is done, started with practices and processes needed to collect the appropriate data for disclosure and the types of resources you could look at. So there'll be 3 parts to this unit. First of all, how to identify sustainability-related risks and opportunities. Then Fiona will take us through a section on evaluation, which will cover more about scenario analysis. And finally, I'll look at how to integrate into your existing processes those practices that you might need to support your sustainability disclosure. So let's start. How to identify sustainability-related risks and opportunities. It can be difficult to know which risks and opportunities you should be reporting on. The ISSB standards themselves say that a company shall consider, when identifying risks and opportunities, the SASB standards. Now, bear in mind that IFRS S1 says that companies must provide material information on all sustainability risks and opportunities. And by saying that the company must consider the SASB standards, we know that these are the 77 sector-specific standards, and they can really help a company to know what could be most material for their own industry. So, for example, if you are in the construction industry, the construction materials SASB standard might say to look at how much waste you generate and whether that is a risk. And in terms of what you might want to disclose, what percentage of that waste is recycled or hazardous, and whether you qualify for credits in sustainable business design. So very specific to your industry by being directed to consider the SASB standards. In addition, companies can consider the IFRS educational material on sustainability risks and opportunities and the disclosure of material information. So that's available on the IFRS website and the Knowledge Hub. It's very comprehensive information there. companies can also consider the CDSB framework application guidance, which contains information on a range of subjects, including water, forests, human capital, and so on. Companies can consult their own industry practices. There are industry bodies that prepare sustainability guidance for them, and also look at the materials of other investor-focused standard setters. So that could include the integrated reporting framework. So once you've identified which risks and opportunities may need to have disclosures made about them, then you're thinking, well, what information shall I disclose? And the same sources of information can be considered, but in addition, companies can look at the GRI standards and the European Sustainability Reporting Standards. Now, we've already seen an example of a company doing this. Do you remember the CLP example, where they reported metrics and targets about their waste management and circular economy progress? So that was a real life example of the GRI and SASB standards having been used to identify the risks and to provide information on the metrics that were used. So let's have a look at an example now, and this is from Ayala, which is a Philippines-based corporation. It's a huge conglomerate company with lots of different industries, and the extract shows the process that Ayala uses for identifying risks to the business, and the process was updated in 2024 and learns from their experience in previous years. So we can see that the meta step, the first step, is communication and consultation, whereby they do a communication exercise to inform their understanding of risks. The first step of the process, though, is to establish the context within which the company operates. So they look at a lot of different sources of risk intelligence, from global risk reports like the World Economic Forum report that Fiona shared with us at the beginning of the presentation. They consult subject matter experts and the management team, and this helps them understand emerging risks and trends within the context within which they operate. Second step, they do some risk assessment. So they identify, analyze, and evaluate the steps. And you can see that in each of these steps, they tell us who is in charge of the process and what sort of output they will get from the step concerned. The third step is to determine what treatment will be applied to the risk. And the fourth step is to understand how the risk will be monitored and reviewed. Let's have a look at another example now, which is from a company called Nest, which is a Finland-based company that produces sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So it uses science and technology to transform waste and other resources into renewable fuels and circular raw materials. Now, in this case, the company is using scenarios to inform their understanding of risk. They use two different scenarios, a world scenario, which they break into two parts. First of all, the world, and secondly, EU and North America. And the reason they do this is because some economies may take action and develop their transition at different paces than others. So in the net zero world scenario, the company anticipates that global action will be taken to limit global warming to about between 1.5 and 2 degrees C by 2050. They use another scenario too, which is a compromised climate target scenario, where climate action is slow and global warming of 2.5 to 3 degrees C is expected. As you can see, they describe each of these scenarios, and they set out the opportunities and risks they expect in different scenarios. They also give an indicative financial impact. Now, in this case, you can see that the most positive financial impact is in the net zero world 2050. And perhaps you would expect that. They see demand for their products increasing and accelerating, and that's what they are in the business of sustainable products, sustainable aviation fuel, for example. So perhaps you would expect that. But the point to make about this example here is that as well as being able to draw on lots of different resources, this company has used scenarios to inform its view of targets. Now, we've talked about the resources you can use, the approaches you can use, the types of steps that we see in different company examples. But the ISSB standards recognize that despite everything, identifying risks and opportunities can be a challenging but valuable exercise. So to make sure that the effort involved in risk identification is proportional to the benefit, the ISSB specify that when applying specific requirements, including on risk identification, companies shall use all information that's available at the reporting date without undue cost or effort. At the same time, companies are required to use all reasonable and supportable information when assessing and disclosing risks and opportunities. So what does this mean? Well, reasonable information and supportable information is that which is specific to the company. So it should be known to the company. It takes account of the external environment, and we saw that within the Ayala example, didn't we? It takes account of past events and current conditions. The company will know about those, but also forecasts, and perhaps forecasts informed by consultation or use of scenarios. And in some cases, what is reasonable and supportable and commensurate with the company's capabilities and resources is specified in the ISSB standards. So we're going to move to the next part of this unit now with Fiona.
Thanks, Lois. So moving on then, let's have a look at the next aspect of our implement module, which we're calling evaluate. So once those risks and opportunities have been identified, the next step will be to evaluate the financial effects of the risks and opportunities. And we know that this can be quite a daunting consideration. So we'll have a little look now at some of the key concepts that you could use to help you get started with this assessment. So just to recap on the objective here, investors are looking to understand overall a company's resilience to the risks and opportunities it's identified. And when we're particularly talking about climate risk in the S2 standard, we're looking for companies to disclose information about the implications of climate change on its strategy and its business model. And companies are also asked for their financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, if your company is in the agricultural industry, you might want to test your resilience against a new regulation to limit certain high emissions activities, or maybe your company's ability to respond to changing crop yields that you could expect if there are more frequent heat waves in the future. And so to do this, you'll need to use climate scenarios drawing from science and analyze how these scenarios will lead to effects for the company. And so it's important to remember that scenario analysis is not asking you to predict the future. It's simply a tool to test your resilience against possible plausible future events. So S2 doesn't actually specify which scenarios a company should use because this is highly dependent on the company's industry, the types of risk it's looking to assess, its geography, etc. But it asks that companies select and use relevant scenarios and that they provide information about which that they have selected. And that also they include information about the assumptions that have been used in the analysis. And the guidance available to companies alongside S2 provides guidance on a range of different practices that could be used here. So everything from qualitative scenario narratives, perhaps at an early stage of understanding on this topic, moving into more complex statistical processes. And overall, as per those kind of proportionality points that Lois has mentioned, companies are asked to use an approach that is commensurate with the company's circumstances and that uses all reasonable and supportable information that's available to the company at the reporting date without undue cost or effort. So looking at an example here, this example comes from Nestle, the multinational company from Switzerland that you're probably familiar with. This is one output from their climate scenario analysis, and it shows their modeling of how they would expect yields of a number of their key agricultural commodities to change under a medium emissions scenario between 2022 and 2040. So whether they're broadly expecting an increase, a decrease in the yields of those commodities. And you'll see a range of things across different markets as to what they're expecting that to mean. And so alongside this kind of visual summary, they summarize in the report a number of the key outcomes that they're going to take forward from this assessment in terms of steps to improve their resilience to these potential uncertainties. So this would include potential product innovation, looking at operational efficiencies, investment in R&D, etc., etc. And so we know when we're talking about anticipating materiality of future events, possible future events, that can, of course, be very challenging. So to help with making this determination, the IFRS S1 standard asks that companies consider various issues to help make this assessment of uncertainties and disclose that level of uncertainty. And so the list you can see here could be considered as a list to identify all the steps and information you need to come to your judgment. For example, companies should be considering all low probability but high impact events. And any uncertainties relating to the company's future cash flows needs to be evaluated. And another important point here is that there is a need to reassess these uncertainties at each reporting period. So although ISSB doesn't require scenario analysis to be repeated every year, this could be integrated instead into the company's strategic planning cycles. It does ask that these uncertainties are continued to be evaluated at each reporting period. Okay, back to you, Lois, for the next segment.
Thank you, Fiona. So, as we've said before, the good news for many of you is that you're likely to have processes and practices and systems that you can use already within your organization that you can use to support your sustainability disclosure. So we're looking at how you can integrate into those practices and processes the sorts of things you'll need for sustainability related information. So what could you do to think about how to use and develop your existing processes? Well, we've already talked about this, haven't we? Conducted gap analysis, and SSE offers a tool for that too, to see where there are gaps in existing processes and systems. The second and third points are about suitability and prioritization criteria, and these recognize that sustainability issues have particular characteristics that are different from other types of risks. They operate over longer time horizons and have a great deal more uncertainty associated with them. So you might want to look at whether your processes need to be developed to be more suitable to cater for those characteristics, and whether you need to use different prioritization criteria for risks, such as likelihood, impact, vulnerability, and speed of onset, as well as probability. You will have internal control systems, and it would be an idea to evaluate how they can be used for managing sustainability related risks and opportunities. And we've seen in some of the examples, haven't we, the combination of internal control and risk management for sustainability disclosure preparation. Think about who within your organization and outside, which departments, which people have processes, systems, and expertise that they can contribute to your sustainability disclosure. What interconnections are there between internal and external factors? So how does the understanding of the risk landscape and context affect your understanding of internal risks? What uncertainties do you encounter in considering sustainability related risks and opportunities, and how should those uncertainties be integrated into your processes so that you can decide what to do about them and what judgments to make? What resources might you need to develop or new systems or manage your existing systems? Do you need to go through a budget control system or change management process? So this is why, all these questions are why we have suggested for your homework that you develop a disclosure plan. So a disclosure plan is a great way to integrate sustainability related risks and opportunities and associated disclosure considerations into a company's practices and processes. It can help you take control of your narrative by being very specific to your company. It can support internal collaboration, knowledge sharing, and cross-functional team discussions. Somebody mentioned in a Menti earlier that one of the problems is fragmented data across departments and systems. If you develop a disclosure plan that records where these fragments are held, it may be a way of planning how you can make them more coherent and efficient across departments. So when you develop your disclosure plan, you'll be thinking about who's going to be involved, make a record of them. Do they come from risk management, company secretarial, procurement and finance? How will those individuals and their departments and systems be organized? What will be their responsibilities? How will they contribute to sustainability reporting? Where is the data sourced? Can you use existing systems and controls? How will you manage assurance and judgments that where there's uncertainty, and how will you manage the different information needs of different stakeholders and so on? And what are the sign-off processes? So in a nutshell, this disclosure plan can be used as a central and ongoing reference point and audit trail, including a record of who's involved and where and how judgments have been made about sustainability disclosure. We'll have a quick look at an example now from Novo Nordisk, which is a Danish pharmaceutical company, about how they put in their reports some of the things that I would expect to see in a disclosure plan. So in this example, just an extract, the company sets out how they have prepared their sustainability statement. And you'll see in the second paragraph, they give us a long list of the standards and guidelines that they've taken into account: the Greenhouse Gas Protocol, the Science-Based Targets Initiative, the TCFD recommendations, the GRI, the regulations to which they are subject. They also tell us the time horizons they've considered for the preparation of the statement. They define what they mean by short term, medium term, and long term. They tell us the circumstances in which they've used estimates and where we can find information about assumptions and uncertainty. And there's a great deal of other contextual information here that helps us to understand how the information has been prepared. So you can imagine that if you are to do this, agreeing it before the reporting year starts is very helpful. And one way of doing that is through a disclosure plan. So let's just look at a Zoom poll here. Is a disclosure plan required by the IFRS sustainability disclosures? Is there a requirement that says you must have a disclosure plan? Thank you for participating. I want to share the result with you. And most of you have said, yes, you must disclose your plan. Actually, the correct answer is no. There is nothing in the IFRS sustainability disclosure standards that requires a company to have a disclosure plan and to provide information about it. There are specific requirements that say you must set out the methodology you've used for certain things, but there's no overall requirement to have a disclosure plan. We're simply suggesting it because we think it's a good idea and it could help you with your planning. So something to think about there. And we're now going to go to Fiona for a summary of Module 3.
Great, thanks, Lois. Okay, so I'll just skip that second poll. I think you kind of got the key concepts there, hopefully, and just wrap up on this module and do our last exercise for this segment as well. So, some of the key things we talked about here were really connections again. We talked in our module 2 about the connections between the different core content areas of the standards. And here we were really talking about the connections between a company and its external and internal environment. And those are really what we need to focus on when we're identifying key risks and opportunities. The second thing we talked about in this module was about evaluating those risks and opportunities, and that a key component of this evaluation is consistency in your assumptions. So, scenario analysis is an important tool to use to, understand your resilience, in particular to climate risk. But if you are using climate scenario analysis, it's important to keep track of those assumptions and disclose those transparently. And if you're new to this topic, that's where using some of the existing tools that are available on scenario analysis as a starting point can be very helpful. We'll share some links to some of those in the chat, and we've got some resources in the handout as well for you. And finally, as we've seen, even if some of this data might not be information that you're currently disclosing, it could already be that you're recording it or collecting it internally for other reasons. Or maybe it's that you have practices or processes in your organization that could be adapted to enable you to capture it. So, as much as you can, trying not to start from scratch and building on what you already have is our advice and encouragement on that point. So, with that in mind, that's what we'll focus on for our reflection activity and Menti for this part of the training. So, what we'd like to think about is what the existing systems and processes that you have for data collection that could potentially be adapted to support you in gathering information on sustainability related risks or opportunities, or perhaps your metrics and targets. So, here you might want to think about particular processes for data collection, ways of managing data, or maybe particular sources of information that you could look to, and how you might be able to integrate those requirements into existing processes. So that's some of the points that we'd encourage you to think about in this area of your disclosure plan. So we'll go back to Menti again now. The link is in the chat, and I'll share the screen as well. Okay, thanks already for those who've responded to us. So I see someone has mentioned here around, the question, as we said, is what are the existing processes for data collection that you could adapt to help you collect sustainability data? Or maybe it's existing sources, for example. So someone's mentioned periodic corporate reporting, leverage, existing annual and interim reporting submission. Yeah, so actually, it may well indeed be that your annual report, maybe within the front half and the narrative reporting, already includes very relevant information relating to sustainability risks and opportunities indeed. So that's a very good reminder that actually you could already be reporting this already, and it's important to check that your disclosure doesn't already include what you need and maybe just to structure it a little bit differently to align. Someone's mentioned adapting their electronic filing system platform to enable submission, storage, and retrievable of sustainability reports. So maybe that's from a central regulatory perspective there to support filing of reports. We'll talk a little bit more about that in our communications section as well, actually, in digital taxonomies there. Someone's mentioned about stakeholder surveys as well. I think that's definitely an important thing to give you some perspectives on key risks and opportunities, absolutely. Highlighting as well that you've got existing processes in HR, procurement, facilities, etc. Indeed, so lots of things already going to be relevant there that you can pull from. So liaising with your colleagues to understand what data that they can provide, maybe what systems they're using that could be adapted, definitely. Established workflows, using those exactly, financial reporting or sustainable supply chain tracking, yeah, for your value chain. I think that's a great source as well. Compliance or risk management systems as well, definitely. Maybe vendor onboarding. Fantastic. You've already got loads of great ideas here. Thanks, everyone. And I think hopefully highlights to those of you who might be coming up with less ideas here that actually there's loads of sources that I'm sure would be relevant for your organization to go away and have a look at. So integrating into existing systems is, I think, really one of the key messages here that it looks like many of you are already taking on board. Other things people have highlighted there is thinking about compliance audit reports. So maybe that's if you've got operational environmental compliance requirements, for example. Definitely there'll be lots of things that might have been recorded there. You might already be completing reports at an asset level that you just need to sort of aggregate up that picture from. Thanks, everyone. I think lots of great suggestions here. And I think, as I said, definitely gets the message across that as much as we can, building on those existing systems and tools that we have is a great idea to move forward with. So thanks for all of those ideas. Okay, let's go back to the presentation now, and I'll pass you over to Rebecca from the IFRS team, who's going to take us through our final module, Communicate.
Hello, can you hear me okay?
Yes, all good. Thanks,
Yes?
Rebecca.
Okay. I don't actually have control of these slides though yet.
Apologies, let me just give you that now.
Yeah, no problem. Okay, perfect. All right. So as Fiona said, we're on the final module. So well done, everyone. We're almost at the end here, and really we're just going to wrap this up in terms of focusing the training on the when, where, and how in terms of sustainability disclosures. So we're going to cover this in 3 main sections, those being location and timing, efficiency, and confidence. So location. So this is really about where, in terms of the location of reporting, disclosure should be located. Okay, so before diving into maybe the specific requirements of the standards, it might be helpful to think about sustainability disclosures in the context of a complete reporting package that is useful for investors. So as previously mentioned, the requirements in the ISSB standards are based on addressing the information needs of investors and effectively build on Is the audio okay still, Fiona?
Yeah, sorry, is there any issue?
Yeah, it's just saying that the audio is not working on my side, but you can still hear me?
There was a brief moment, but we've got you back now.
Okay, apologies. All right, so in terms of building on past standards, like we said, TCFD, SASB, and GRI. So one of the major advancements that ISSB standards bring that era of accounting and the focus on connectivity. So while the ISSB and GRI standards do share some content requirements, that is what information to report. Apologies again, I'm getting a warning that
Yeah, it's breaking up slightly. I'm not sure if it's the headset or
yeah, it's saying my internet is unstable. I'm so sorry. Does it work now? Can you hear me okay?
it is. Yeah, I'll let you know if it's maybe proving a problem. We can step in if needed.
Okay. All right, apologies for that. So as I said, so the ISSB JRI standards again share some content requirements, but they have very different objectives. So again, ISSB, that's really focused on the investor information needs and decision making, whereas with IFRS, it's all about the investor need. Or GRI, apologies, it's about the stakeholder need. So even though they're different, they are complementary, and in practice, the GRI approach is more commonly understood among sustainability practitioners, I would say, whereas the IFRS approach is more likely to be familiar with accounting professionals or finance executives. So again, many of the impacts traditionally identified as material under GRI standards may give rise to sustainability-related risks and opportunities that are likely to affect a company's prospects, and therefore investors would then need information about them. So you can find some more information around the potential areas of focus for disclosures for investors in your handouts. I think we're okay with the sound now.
Yes,
All right.
all good.
Those things about working from home, right? So what is material information? So we have discussed a bit of this already in the course, but Moving on to materiality, you've probably come across various references to the different types of materiality based on different reporting standards and frameworks. So it's helpful here just to recap what we mean by material information when it comes to the ISSB standards. So as we discussed in the first module, information is material when it influences decisions of primary users of general purpose financial reports, so in other words, investors, and informs their decisions about things like providing resources to a particular company, buying or selling equity or debt instruments, as well as grant loans or other forms of credit. Also, something to consider is voting. So, in terms of influencing how management uses a company's economic resources. And in this context, when preparing disclosures, the key consideration here is really the characteristic of the investors and the company's own circumstances. So what do I mean by that? Well, for example, different investors can have different and sometimes conflicting information needs. And therefore, the intent of sustainability disclosures under ISSB is really to meet the common information needs of investors. And this is really about the key information that an average investor would be looking for. So another thing that I briefly mentioned, but I'll just reiterate here, is that materiality is a characteristic of information, and the ISSB standards take a two-level approach to this. First, around identifying the sustainability risks and opportunities that are likely to impact a company's prospects, which Lois and Bella have touched on. And then also the next level is that material information. So what is the information about those things that investors would need? Okay. So disclosing material information. So when it comes to disclosing material information under ISSB standards, S1 requires material information to be clearly identifiable and that the information is clear and concise. So what this means in practice is really material information shouldn't be obscured by other non-material information. For example, information that a company discloses on the basis of, say, another reporting framework that is not centered on the information needs of investors, but may focus more broadly on different stakeholder information needs, such as GRI. And why is this important? Well, first of all, the location of sustainability-related financial information within general purpose financial reports may vary between companies and across jurisdictions. Also, information designed to meet the needs of other stakeholders beyond investors might be provided voluntarily or to meet regulatory requirements. And the potential problem or issue here is that material information reported under ISSB standards could be obscured because it might be buried amongst a whole host of other information that's been prepared for different audiences and according to different objectives that might not align exactly with ISSB standards. So this could also be problematic in cases where reports are perhaps poorly organized in terms of content, and therefore, again, material information is scattered throughout the report. And why is this important? Well, because a company won't be able to assert compliance, which I'll talk about in a little bit, with the ISSB standards if a report is overloaded with irrelevant data or if it blends information for different audiences without clearly identifying the information that is material for investors. So as mentioned previously, the IFRS Foundation has published some good education material in 2024 on this topic, so you can follow the link here. Okay. And now we're going to move to a quick poll. Oh, I think we've got an old poll here. 1 second here.
Sorry about that. You're right, Rebecca. I've launched the wrong poll. Apologies for that, everyone. Let me go back and I'll share the right one with you. We're up to number 11 now. Is that correct?
Yes.
Yeah, thank you.
It's not
Sorry
our day
that,
for
everyone.
technology. Okay. So information should be disclosed in the annual reports when applying ISSB standards if and select all that apply. So omitting that information could reasonably be expected to influence investors' decisions. It could reasonably be expected to affect the entity's cash flows. It exemplifies the values of the leadership team. So I'm just going to give a few more seconds to people. We've got 24 participants, 24%. So let's get that up a little teeny bit. All right, interest of time, I'm going to end the poll there. Okay, so well done. So answers are A and B. The last one is interesting. So unless it's been determined that a particular values being exemplified are expected to have a financial effect on the company, this may not actually be material information. Okay. So now we're moving on to, there's the poll. Where to report for ISSB. Okay, so we're turning to the topic of location and where to report under ISSB standards. The standards talk about disclosures being made available at the same time and on the same terms as the financial statement. That is, as part of the same general purpose financial reporting package. That said, S1 does not have requirements that specify the exact placement of that information. And this just means that ISSB standards don't specify where within the overall reporting package the information has to be provided. And this is really by design in order to give some flexibility and accommodate jurisdictional specific requirements on the location of reporting. The most important factor to consider here is to ensure that the sustainability disclosures are for the same reporting entity as the related financial statements. And again, that they're disclosed at the same time as the financial statements covering the same period. And it's worth noting that standalone sustainability reports are not prohibited by the ISSB standards, again, provided that report forms part of the general purpose financial reporting package. And we have seen that in jurisdictions like Turkey, where there's actually a requirement to have a separate compliant report. Okay. A company might also choose to have a distinct, so as I said, there's requirements in Turkey, but you can decide to perhaps have a standalone report issued alongside a broader package. And in practice, this is where the use of cross-referencing really comes into play. So that is, the cross-reference information must be available on the same terms and at the same time as the sustainability-related disclosures, as I've already mentioned. And importantly, the complete set of disclosures must not be made less understandable by including information by cross-referencing. So importantly, cross-referenced information also becomes part of the complete set of disclosures made under ISSB, and as such, that information must comply with all of the ISSB requirements, including things like being relevant, comparable, verifiable, etc. So to get a better idea of what this looks like in practice, I'll pass over to Lois for a quick example.
Thank you, Rebecca. And rather than giving you one example here, we're looking at a study from the World Business Council for Sustainable Development's 2025 Reporting Matters study. And this is their annual review of corporate reporting practice from a selection of global companies. So as Rebecca's indicated, how a company reports is, of course, must take account of any regulatory requirements. But this study shows that standalone sustainability reports remain the predominant approach in 2025. So on the top line there, you can see that standalone reports comprise 54% of reports in this year's sample. If we compare that to previous years, 2024 and 2023, we can see that there is a decline in standalone reports, notwithstanding that they remain predominant. And this may well be because of regulatory requirements coming into place around the world, so that require more integration of sustainability and financial information. The picture also varies depending upon where in the world you are looking. So in the Americas, we can see in the green bars that standalone reporting is 81%, so much more standalone sustainability reporting in the Americas. In APAC, 58% and EMEA 39%, perhaps reflecting the fact that there is more regulation in Europe. So just a snapshot of practices, but again, for individual companies to be determined depending on their regulatory context. So back to you now, Rebecca.
Thanks, Liz. Okay, so we'll briefly talk about the evolution to digital reporting and the ISSB taxonomy, which some of you may have heard about. So in general, the term taxonomy is really just a general word for classification system and is often times companies will have their own internal taxonomies that essentially help them identify and define key terms across the business or the function. You may have also come across the reference to a taxonomy in the context of sustainable finance taxonomies, such as the EU taxonomy, but also a growing number of countries that have developed green taxonomies, and these are often core components of a broader sustainable finance framework. And what these taxonomies do is that they essentially help to classify different types of economic activity or investment as sustainable. So now in comparison, even though I've explained all of that, when we talk about ISSB taxonomy, we're actually referring to something quite a bit different. And it still means a type of classification system, but it's referring to one that is used to categorize information within a report. And in this world of AI and push towards digitization, you've probably seen a shift or transition away from traditional PDF formats, although what Lois said, it still looks like there's a lot of individual reports out there. But increasingly, we're seeing information on websites contained in structured data sets, such as databases that are offered by stock exchanges or regulators. So recognizing this digital shift, the IFRS Foundation has subsequently developed the ISSB taxonomy, which is essentially a machine-readable digital tagging system. It was published in April 2024, and the overall intent, again, is to help investors analyze sustainability reports and all the information contained therein. So how does the taxonomy do this? Well, essentially, it translates the requirements of IFRS S1 and S2 into standardized data tags, which facilitate digital reporting and makes it easier for investors and data platforms alike to take large data sets, like information from an entire industry, say, and bring it together for analysis. I will just note that the ISSB taxonomy is not mandatory for compliance with the ISSB standards themselves, but rather, excuse me, the taxonomy is designed to support the digital submission of ISSB disclosures. And that comes with a few benefits, which some of you may already experience if you do digital tagging for financial disclosures, but things like making reporting information easier for analysts to use, having a same kind of structured data set across businesses, sectors, geographies, all machine readable. You can then compare quite a bit more easily. Also, tagging information can help facilitate automated checks for quality and consistency. And it can also improve the overall report preparation, given that more data collection and management systems are becoming more and more compatible with digital reporting taxonomies. And last but not least, digital tags can have labels and descriptions in multiple languages. And that's really wonderful because it enhances the accessibility of information across different languages. Okay, so we've got through the first bit on location, and now we're going to touch on efficiency, how to communicate efficiently and effectively. So what does effective communication actually mean, and what does it look like? So often companies think that if they just put a whole bunch of information that they have into a report, then they've covered everything, readers will be satisfied. However, when you think about ISSB standards, remember that a core conceptual foundation is fair presentation. which means that a complete set of sustainability-related disclosures under ISSB should present fairly all sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. So it's not about putting everything about sustainability into a report. It's about presenting material information that we touched on earlier, meaning information that is complete, neutral, and provides an accurate depiction of risks and opportunities that companies face. S1 also requires information to be clear and concise. And the clearest form that disclosure can take will obviously depend on the nature of information. So this might, for example, include the use of tables or graphs, even diagrams with accompanying text, like a lot of the examples that Lois went through today. And in terms of being concise, well, this really means that companies should avoid unnecessary duplication, use clear language, and avoid boilerplate information. Okay, we'll spend a few minutes talking about the quality of information to report and how traditionally, I would say the disclosure of sustainability information compared to financial information has been different. So accountants in the audience are probably very familiar with the rigor that's required when it comes to data collection, oversight, sign-off, and even external assurance that is associated with the preparation of financial statements. And this whole concept of a very strong internal control environment is really well understood. In comparison, I would say sustainability information has not traditionally been prepared under the same type of control environment. And because of this, the ISSB standards really do focus on key elements of quality. So, for example, 3 requirements related to providing comparative information. So from previous reporting period, again, except for that first year of reporting where there's a transition relief, as well as requirements that deal with restatements and the need to restate comparative information or amounts for a prior period disclosed in the case of a material error. Again, focusing on quality, companies should avoid unnecessary duplication, and you can achieve this through the use of cross-referencing. We've also discussed materiality previously, whereby ISSB standards require disclosure of material information and that companies provide connected information. So this means highlighting the connections between risks and opportunities, between core content area, and of course, between sustainability information and the financial statements. And last but not least, when aggregating information should be aggregated if it has shared characteristics and disaggregated if not. Okay. So moving on to cross-referencing. So as many of you have probably noticed, there may appear to be some overlap in topics covered in the information disclosed across different reports or sections of reports. And in fact, IFRS S1 actually then requires a company to avoid unnecessary duplication. So, for example, if a company has the same governance approach for all sustainability-related issues, then this information would only need to be disclosed once. So if climate-related risks and opportunities are governed the same as other sustainability risks and opportunities, that information can be disclosed as a whole. Also, perhaps the information required by ISSB standards is in another report that a company publishes. So, for example, the financial statements. Then the company can include material information in its ISSB disclosures by cross-referencing. But as we discussed earlier, cross-referencing is only allowed provided other report is available on the same terms and at the same time. And to help us make sense of this whole concept in real life, I'll pass it back to Lois for an example.
Thanks, Rebecca. As you can appreciate, there are many different ways of doing cross-referencing, and this is only one example from ArcelorMittal, which is a steel producing company. You'll be familiar now with all of the terms on the left-hand side of this table in the left-hand column: governance, business model, risks and opportunities, strategy and resource allocation, etc. So they're describing down the left-hand side the content elements that people might want to read about. And then on the right-hand side of this table, they're telling us where we can find information about these subjects. So in some cases, and this is an extract from their sustainability report, you'll see that they're cross-referring within the sustainability report and telling us the section that we refer to. So in business model, we look at the business model section of the sustainability report. In other cases, the information is spread more widely. So when we look at strategy and resource allocation, the cross-reference is to multiple places. The business model section in the sustainability report, also the annual report, and also the 20F, which is a US registration document. So just a way of directing the reader, navigating them towards where they'll find different information about different subjects. Back to you, Rebecca.
Okay, so mechanisms that support adoption. So Lois has touched on this in an earlier section, but so I won't go into too much detail here, but really just wanted to highlight the fact that there are mechanisms within the standards that are really meant to support preparers get started with the ISSB standards. And also this is in recognition that there are varying degrees of maturity when it comes to sustainability reporting. So as you can see on the slide, we have here just some samples in terms of the proportionality mechanisms that the standards adopt. Again, these are things in terms of accounting, use of well-known terminology and concepts that will be familiar to financial accounting. Also, the use of reasonable and supportable information available without undue cost or effort. Scenario analysis being permitted, disproportionate mechanism when conducting scenario analysis, and then also considering the skills and capabilities and resources that might be available to a company. There's also a number of reliefs within the standards. So for example, in the first year, there's a climate first approach whereby companies can report their climate sustainability related risks. They still have to apply S1 for those core foundational components, but we see many jurisdictions adopting that climate first transition. There's also Scope 3 transition reliefs that relate to Scope 3, being that Scope 3 emissions are not required in the first year of reporting. We also mentioned previously about the GHG protocol and the use of an alternative measurement approach, which can be used again for that first year. And as we said, also comparatives. So comparatives in those first years are not required. Okay, so another relief allows companies to include the sources of guidance. So again, those are meant to help in terms of when you're identifying sustainability risks and opportunity and the information to disclose. So things like the SASB standards. Okay. Interest of time, we're going to skip through the polls. My computer is probably thankful for that. Something's going on. All right. So finally, the last section, the final unit, looks at how you ensure that the users of financial reports have confidence in the information that you're disclosing. And this is especially important being as trust is so essential in terms of sustainability disclosures and increasingly with concerns like greenwashing. Okay. So comparative information. So an important trust builder is showing data and trends over time. So as such, S1 requires that companies disclose comparative information for the preceding period for all amounts disclosed. And this also relates to qualitative or narrative information if that is deemed useful to investors. And why is comparative information so important? Well, it really helps to emphasize context and also allows companies to demonstrate relative progress over time, as well as communicating changes or evolutions to a company's strategy and risk management processes. Also, metrics disclosed by a company might be redefined or replaced over time, or a company might change its methodology for how it estimates a particular metric. And in these situations, it's important that a company revises the comparatives so that investors can analyze the current period figures with the relevant prior period. A company might also have new information compared to a prior year. For example, say a company obtains actual GHG emission data from its supply chain that it only had estimated before. So then the company would need to revise that information, again, if material. Occasionally, a company's sustainability disclosures may well contain material errors, and in this situation, a company is required to restate these errors in the comparatives provided. And just to note, revisions or restatements are only necessary when there's a risk of material information being omitted, misstated, or obscured because of not revising or restating the comparatives. Okay, statement of compliance. So finally, it's important to build confidence by providing clear statements of compliance. And in fact, a company that complies with all of the requirements of the ISSB standards is required to make an explicit statement of compliance. It's important to emphasize that a company can still make this statement if it has decided to make use of the specific transition reliefs in the first year of ISSB reporting, or if the company is using any of the proportionality mechanisms. So there are two exceptions where information required by ISSB standards could be omitted that would still allow a company to make a statement of compliance. These exceptions relate to commercially sensitive information and when law or regulation prohibits disclosure of certain information. So for that first one, commercially sensitive information, what this essentially means is that a company does not have to disclose information about a sustainability-related opportunity if the information is deemed commercially sensitive. And you'll note there that I said opportunity. So that's where it applies only to sustainability-related opportunities, not risks. And there's additional details in your handout if you want more information on this. The second exception is if a company is prohibited by law or regulation from disclosing certain information required under ISSB standards. And in this case, disclosures can be omitted and a company can still make a statement of compliance. Importantly, companies that are beginning to phase in the ISSB standards voluntarily and are therefore only partially aligning to the standards, these companies would not actually be able to make a statement of compliance. Instead, what we typically see companies is disclose an explanation of where they are in their disclosure journey, so to speak, and outlining what measures they're taking to enable future compliance with the standards. Okay, a few things to keep in mind as we wrap up. Just got them here on the slide because I realize we're almost at time. But there is, this information is available obviously in your handout for you to have a look at later on. Fiona, back to you.
Thank you, Rebecca. Brilliant. Okay, great. That brings us up to the end of our final module together. So only a couple more minutes left in the training. I know a few people have mentioned that they're finding the session a bit long. We do really appreciate that. There is a lot to cover, I think you'll see, but hopefully this has been a good overview. But just to wrap us up now on this module, we really talked here about being clear on your audience and who you're reporting to. So the primary users of IFRS related disclosures are investors. So that's really the focus audience that you should summarize and aim towards for this reporting. We then talked about efficiency, and I think a key takeaway here is that less is more. Our aim isn't to overload our investors with information. It's really just to use the standards to provide concise and materially focused information that supports their decision making. And then finally, Rebecca talked us through report user confidence. We know that it's important that our data is not only accurate, but that we present it in a balanced and transparent way that builds trust among users. And so that's where using that disclosure plan that we've shared with you as a structure throughout today's training can support you as well. Okay, so in the interest of time, I'm going to skip through our final exercise. You can take a look at that in the homework exercise if you'd like to have a look at that topic. But I'd like to know in Menti, before we wrap up with a few resources, how you're feeling in terms of your understanding and comfort on the ISSB standards now. So I'll just share the screen quickly for us to have a quick look at that together. If you remember, we asked this question at the start of the session, so it's always useful for us to get a sense of how effective our training has been and how comfortable you might be feeling now that we've completed the training. We know we can't necessarily solve everyone's problems, but hopefully you are feeling a little bit happier. I see our one respondent who's come back so far has indicated a good result on explaining the ISSB, but maybe a little bit more work to do on using the standards and developing a strategy. So, of course, that's very understandable. We'll leave that question open. Would encourage you to respond to that in Menti. It's great for us to know. And then whilst we're just closing the session, I'll just go back to the slides. We'll highlight for you now a few key resources to take away, and of course, come to the all-important point about your certificates as well. So just to mention, we've talked about this already, our homework assignment. This isn't mandatory to complete, but you can access it from the webpage that Lois has just shared the link to in the chat. At the bottom of that page, you'll find the slide presentation from today, the homework assignment if you'd like to use that to work on your own disclosure plan. And we'll also add our recording of the session to this page as well. Few resources that are included in the slide handout here that can help you to take forward your learning journey. I know a few people have asked about where to get some more resources or learning courses. So to highlight in particular, we've got the IFRS Knowledge Hub, which is a repository with lots of information from the IFRS team, case studies, resources, webinars, etc. you can take away. There's also 4 further e-learning modules which the IFRS Foundation have developed to support adoption of the ISSB standards. And a number of these are CPD certified, or they're all CPD certified, I think, in fact. So you can take those courses as well if you're interested to further develop your learning. As well, a couple of other things that the IFRS team will highlight. There's the FSA credential that you can undertake if you'd really like to develop your knowledge further. You can also consider joining the IFRS Sustainability Alliance, or you can explore a little bit more about licensing and use of the IFRS standards. Perhaps if you're a service or solution provider, for example, who'd like to build a product based on the standards. And finally, the IFRS conference is coming up at the end of the month, so I encourage you to check that out if you're happening to be in London or if you're interested to join online to that event as well. Our colleagues at the IFC also have a whole host of resources available here. A big thank you again to Lopa for joining us in the session today. So be sure to check out the Beyond the Balance Sheet programme from the IFC, which you can find at the link that Lois has shared in the chat and also access from the slide presentation here. In particular, I'd highlight the e-learning course that the IFC have developed on sustainability reporting essentials, which may also be very helpful for you. And last but not least, a reminder on the SSE's toolkit of resources that we've developed to support adoption of the sustainability-related financial disclosure practices as well. So be sure to check that out. This also includes a number of FAQs that we've developed from this training that you can use to think about some common implementation challenges. And thank you also, Lopa, for sharing your details in the chat with everyone as well. If they'd like to reach out to you as well, that's great. So I know a very important point we need to finish on before we close the session is how to get your completion certificate. So a big thank you and well done to everyone who stuck with us throughout this 3.5 hours of training. We know that's a long time to be together online and there's a lot to learn, so we're really appreciative of that. To get your completion certificate, we would ask that you fill out the feedback form, which Lois has just shared the link to in the chat with you now. If you take part in that survey, obviously we'd love to have your feedback on the training, but what we'll do is we'll use the details that you submit into the feedback survey to send you your completion certificate via email. It usually takes around 1 week to receive your certificate, so please be patient, I should say, if you don't receive your certificate straight away. And also make sure to check your junk folders in case you're missing your certificate. It might have gone to your spam folder. If you missed the link in the chat, it's there for you now. You'll also get an email from Zoom within 24 hours of today's session that will reshare that link with you again to fill out the survey and get your certificate. But lastly, I just want to close out the session by saying a few thank yous. Firstly, a big thank you to all of the SSE supporters, a group of stock exchanges and other organisations promoting sustainable capital markets and help making our work possible. So as a reminder, supporters also receive early access to our training programmes. So if this is something you're interested to know more about, feel free to reach out to the SSE team to learn more about this programme. Of course, as we're closing today's session, a big thank you to a number of organisations. Firstly, to our hosts, the Chittagong Stock Exchange, a big thank you for bringing us together for today's workshop. Also, a thank you to our partners at the IFC and the IFRS Foundation, in particular to Lopa, Bella, Rebecca and Robert, who joined us today. And finally, a big thank you to all of you who joined us as participants. It's been great to have you with us in the session. We hope you've enjoyed the programme and wishing you a good rest of your day. So we'll close our session together there. A big thanks, everyone, and we hope to see you again in the future at another workshop. Thanks, everyone.